All right, let's hit the movers board, because this board is already spicy pre-market. SPY barely green, QQQ up 0.25%, IWM basically flat, VIX down a touch. So the tape is calm, but these small names are not calm at all. Wedo is the monster, up 180%, almost 579 times relative volume. STKH right behind it, up 128. CapR up 85, Surge up 71, and look at that volume number, over 143 million shares already. So here at the markets desk, this is the job. Don't just stare at the percent gain. We want volume, float, where the bid showed up, and whether this is real continuation or just pre-market air. All right, let's pull up WETO. This is the wild one on the tape right now. Market's barely green, breadth mixed, and this thing is up around 180 plus. That's the kind of relative move that gets the markets desk's attention fast. On the 1 minute, the move started around that 950 area, undercut to 923, then buyers just jammed it. Higher highs, higher lows, and then oof, look at that expansion candle. Volume kicked from roughly 55,000 shares into the 240,000 zone early. Then later, the real ignition candle printed over 1 million shares into 1174. That's the day high level on this read. Now the structure matters. After the 1174 spike, it didn't just instantly die. It chopped in a pretty wide range. Call it 1040 to 1130. Resistance is sitting around 1130. Support was trying to hold near 1050. Right now, the latest read has it stalling around 1020-ish, and the volume is fading on the pullback. That's not automatically bearish, but it does mean the clean momentum phase is over for the moment. For the scorecard, above 1130 is the reclaim level I care about. Below 1050, this can get way more slippery, because then you're losing the range floor after a parabolic push. Catalyst-wise, this has a robotics headline stack behind it. Warehouse Robotics Cooperation, a North American commercial agreement, and an NVIDIA Jetson-powered wearable robotics platform press release from late July. So yeah, the market has a story to trade here, but this is still a small-cap China-listed tech name with about 5.7 million float showing. And the dilution page matters. Active shelf, active equity line, 16 total offerings tracked, and 60 million raised over the last 12 months. So I'm treating WETO as a momentum chart first, not a clean long-term read. Great action, huge volume, but the risk is real, 1130 above, 1050 below.
Thanks. Markets desk, let's stay with AI for a minute and pull up NVIDIA first. Alright, so the tape is only mildly green here. QQQ up about 0.25%. SPY barely green. VIX lower. NVIDIA's around 225.63, basically flat to slightly green. So this is not some panic squeeze at the open. The company desk question is simple. Does the AI story this morning actually change the demand picture? Or is this just the market repaying the same leader? Biggest clean reference I see from the company data is that 236.54 year high area overhead. If NVDA starts working back above that, that's the level where the story gets louder again. Now, let's go to the actual news feed, because this is where NVIDIA gets interesting. The headline stat today is not one single earnings style catalyst. It's more like a theme getting reinforced from 3 angles. You've got the robotics headline saying NVIDIA stock has already risen 11% over the past month, and robotics could keep supporting momentum. Then you've got this Grok story, former rival tech and talent, and now the rest of Grok turning into a customer through Grok Cloud. That matters because it frames NVIDIA less like just a chip supplier and more like the ecosystem other AI companies have to plug into. Then the recent press releases point to Blackwell B300 capacity, GPU as a service, even public airspace protection work with Lockheed Martin and Verizon. So what changes? Not near-term numbers in this dataset. The change is narrative breadth, data center, robotics, defense-adjacent AI, cloud compute. That's why the market keeps giving NVDA the benefit of the doubt. Now, Broadcom. And this is the confirmation check. If NVIDIA is the face of the AI train, Broadcom is one of the big plumbing names. Custom silicon, networking, infrastructure. I don't have a fresh Broadcom-specific headline in this packet. So I'm not going to invent a catalyst. This is a chart confirmation name for me. If AVGO is firm while NVIDIA is firm, that tells you the market is still buying the broader AI buildout, not just chasing one ticker. If AVGO can't participate, then the AI trade is a lot narrower than the headlines make it feel. Let's rotate to Marvell, because MRVL sits in that middle lane of the AI story. Not the mega poster child, not the pure GPU symbol, but very much tied into the question of moving data, custom compute, optical, and networking bottlenecks. And honestly, that's the part of AI a lot of people miss. The chip is exciting, but the system has to move massive amounts of data without choking. So for MRVL, the business question is, does the market believe the AI CapEx cycle is broad enough to reward second and third layer suppliers? If this chart is holding up with the group, that's a healthier AI tape. If it fades while NVIDIA holds, that tells you investors still want the safest leader first. And then, AMD is the really useful read, because this is the competitive appetite check. NVIDIA headlines like the Grok one can actually cut both ways. On one hand, they scream ecosystem strength for NVIDIA. On the other hand, if even former rivals become NVIDIA customers, you have to ask whether the market is rewarding alternatives or just rewarding NVIDIA's lock-in. So with AMD, I'm watching whether the chart trades like a true AI sympathy name or whether it lags because investors are saying, yeah, we still want the leader. No need to force a call here. The relative action between AMD and NVDA tells the story better than any slogan does. So here's the company desk scorecard. NVIDIA's story is broadening. Robotics, Grok, Blackwell capacity, defense-adjacent AI use cases. But the stock is still trading like a leader that needs confirmation, not like a name exploding on a brand new number. AVGO and MRVL tell us whether AI infrastructure breadth is real. AMD tells us whether the market wants the challenger or just the champion. And with retail sales at 12:30 and Michigan sentiment at 2 o'clock, semis can still get jerked around by the macro tape later. Coming up, we'll flip back into the movers board and see where the pre-market heat is actually landing. Let's talk Pershing Square buys Netflix stake. The names actually carrying it right now, NVDA and the rest of the group, AVGO, MRVL, AMD. The headline driving it, GDS Holdings returns to profit and doubles AI bookings target. I'm pulling up NVDA first to read the tape, then we'll rotate through the others. Who's leading, who's lagging, whether the whole group's moving together. This is the theme and the price action, not a call on any of them.
Thanks, company desk. All right, markets desk back on the movers board. And this tape is still sneaky. SPY barely green, QQQ leading a bit, VIX red, breadth mixed. But the top of this board is not mixed. It's wild. Weto's still sitting up there, STKH still a double, Capper still hanging around the top three. But I don't want to waste time rereading the same setups. The fresh heat now is Surge, 41-cent stock, up almost 70%, monster relative volume. AKN's next with a mid-7 handle and a tighter float. Then we've got the pain names too. INV down 40 plus, MVIS hit hard. So this is not one clean market story. This is pockets, momentum pockets, liquidation pockets, and we're going chart by chart. First, quick scorekeeping on WETO, because this is exactly why we track levels out loud. The downside flags got hit, under 1050, then under 10 at 853. No victory lap, just scoreboard. That told you the chase got crowded and the spike started leaking. Now the board has it back around 1023. So the question is simple. Can it actually rebuild above 10? Or is this just a bounce inside a broken move? The open upside level is still 1130. That's the spot where momentum gets interesting again. Below that, I'm not treating it like clean continuation. I'm treating it like a very hot small cap tape that already punished late buyers once, this morning. Now, SURG is the one that jumps off the board for pure volume insanity. We're talking 41 cents, up about 69%, and the volume number is just silly, 149 million shares against an average around 132,000. That's over 1,100 times relative volume. So yeah, scanners are absolutely all over it. The revenue headline is the context people are latching onto. But on a 40-cent penny name with high dilution risk, the chart has to prove it. I'm watching that 40-cent area as the first real line. If buyers keep defending above it, okay, momentum can keep recycling. If it slips back under 40 and can't reclaim, that's usually where these start turning into chase trap candles real fast.
Thanks, Markets Desk. Breaking right now. ProTerminal is tracking S&P Global under pressure after a Q2 earnings miss. The headline, revenue came in at $4.15 billion, up 11% year over year and ahead of estimates. But adjusted EPS was $4.08 versus the $4.75 consensus. That miss is the problem, and shares are down about 5.2% pre-market. What we know, the top line held up, margins expanded, but the profit line missed where investors were leaning. What we don't know yet is whether the market treats that as a one-quarter stumble or a valuation reset for the financial data group. And that matters because the tape is not exactly falling apart. SPY's around 778.8, up 0.12%. QQQ up 0.29%. So this looks like an SPGI-specific punishment, not a broad risk-off bonfire. Next headline, the Fed held rates steady at 3.50% to 3.75%, but the wrinkle is the descent. 3 officials favored a hike. And here at the macro desk, that's the part that matters. A hold with 3 hike descents is not exactly everyone singing from the same hymn sheet. It's more like the committee said, "We're fine," while 3 people were already reaching for the fire extinguisher. For investors, the point is simple. The policy rate didn't move, but the inflation concern did not disappear. That keeps duration, growth stocks, the dollar, and gold all sensitive to every next inflation and consumer read. And the follow-through headline. Markets rallied briefly after the Fed hold, but the cross-asset tape got messy fast. The dollar dropped about 0.31%. 10-year yields dipped, then reversed higher by roughly 3.9 basis points. That's the bond market saying, nice hold, but we still have questions. Gold's bid this morning, up about 0.58%. Oil's a little softer, down 0.22%. And crypto-linked names are not getting the same relief bid, with BITO down 1.17%, Coin down 1.1%, and MSTR down 1.65%. So the macro read is, equities are calm, volatility is lighter with VIX near 19.44, but rates are still the steering wheel. Coming up, we'll kick it back toward the movers board and see which single names are ignoring all of this.
Thanks, Macro Desk. Let's hit CGTL because this small cap chart is nasty. 1-minute chart up now. Early rip from about $5.78 to $7.25. Big volume candles. We're talking 700K plus prints. And then, oof, look at that fade. Last read is closer to $4.90, and the candle package has it basing around $4.80 to $4.85. So yeah, headline gain is around 42%, but this is not clean squeeze mode anymore. This is spike, reject, lower highs. Here's the score on the tape. Buyers won the opening blast. Sellers have won everything after the $7.25 high. The level underneath is obvious, 470 to 465. That's the little base. If 465 breaks below, this fade can get ugly fast because now you're losing the low after already giving back the whole spike. On the upside, I need to see $5.80 reclaimed before I'd even call it a real reset. That's basically the open/resistance zone from the chart. No clean VWAP print in this data packet. So here at the markets desk, I'm using the open, the high, and the low as the anchors. And remember, float is only about 8.7 million shares. These things can halt, can wick, can trap both sides. We're reading levels, not hyping the move.
Thanks, Markets Desk. Quick market minute reset here at the macro desk. It's 9:02 a.m. Eastern. Opening bell coming up, and the tape is trying to act calm without making a big speech about it. SPY's at 778.7, up a tenth. QQQ's the leader so far, 734 even, up about 0.25%. IWM's barely green at 303.7, and VIX is slipping to 19.44, down almost 0.9%. So the message is pretty simple. Not broad risk on, not risk off panic. More like the market put on a clean shirt and is pretending yesterday's Fed drama didn't happen. Brent is still mixed though, so don't confuse green index prints with everything working underneath. The cross-asset story is the useful part. Dollar's a little softer at 28.13, down 0.18%. The yen proxy is firmer at 57.83. Gold is catching a bid, GLD 401.28 up 0.58%, while oil is a touch lower at 124.75. That combination says the market's not fully celebrating. It's more of a controlled exhale after the Fed hold and the dissent chatter. Bonds are split too. TLT down 0.23%. IEF up a hair, so duration isn't giving stocks a clean green light yet. And crypto-linked names are heavy. BITO down 1.17%, Coin down 1.1%, MSTR down 1.65%. So the speculative end of the pool is not exactly doing cannonballs. What I'm watching into the open, QQQ holding above that 734 area, VIX staying under 20, oil staying offered. And then later today, retail sales at 12:30 and Michigan sentiment at 2. Coming up, we'll kick it back to the movers board and see which names are actually earning their green candles.
Thanks, Macro Desk. All right, Markets Desk, back on the movers board. Tape is green but sleepy. SPY barely positive. QQQ up about 0.25%. VIX lower, breadth mixed. So when this board is showing WETO still up 170, STKH up 100, Capper up 88, that is single name chaos, knock index beta. HHS is the fresh one I want to hit first, up 70% around 478. AKAN is still playing with that $8 line we already circled. And scoreboard note, SERG below 40 cents got tagged, so that one goes from breakout mode to prove it mode. We're going chart by chart now. First chart, HHS. This is Hart Hanks, not the biggest volume name on the board, but it's fresh heat. Up about 70% on just over 800,000 shares. Relative volume almost 8 times normal. Price is sitting around 478, so the lines are not complicated. $5 overhead is the obvious magnet. 450 underneath is the first area where I'd want to see buyers defend, if this is real momentum and not just a pre-market air pocket. Oof, and with these small floats, that wick risk is real. One fast rejection at 5 can change the whole personality. So for the Markets Desk scoreboard, HHS above 5 is the upside reclaim line. Below 450, I stop treating it like clean momentum. Now Capper, this is the cleaner biotech gap leader on the board. It's up about 88%, doing more than 20 million shares, and the key is super simple, $8. We're sitting right around 7.90-ish on the board. So if this 1-minute chart starts accepting above 8, not just a wick, actual candles holding up there, then buyers are saying the pre-market move still matters. If it tags 8 and immediately gets stuffed back under it, that's rejection, and then the gap can get real choppy fast. So for Capper, I'm not chasing the headline. I'm watching the behavior around 8. STKH next, and this one is way more dangerous because that float is tiny. We're talking under 500,000 shares in the float, up about 100%, with volume already over 11 million. So yeah, it can squeeze, but it can also rug pull like crazy. The zone I care about is 6. If the bid keeps stepping in under 6 and it keeps reclaiming, that's strength. If 6 turns into a ceiling and every pop gets sold, that's the fast fade setup you see in these microfloat names. This is exactly where you don't marry the move. You read the tape candle by candle. Wedo, quick scoreboard check here, because we already hit this one earlier. And yeah, it's still gigantic on the board, up about 171%. 26.9 million shares traded, relative volume almost 600 times normal. But the question now is not, is it up a lot? We know that. The question is, after those downside hits, is it stabilizing or is it still leaking? Board marks around 980, so for me the clean repair level is $10. If the 1 minute keeps rejecting under 10, that's still a lower high look. If it can actually reclaim 10 and hold above it, okay, then the tape changes a little. Under 950 though, that's where I'd worry the fade is still in control. Now Surge, totally different animal. This is the penny stock volume monster, 38 cents, up about 55%. And listen to this volume, 154 million shares, relative volume over 1,100 times average. So the crowd is absolutely here. But this is also high dilution risk, low price tape. So don't treat it like a normal large cap chart. 40 cents is the scoreboard line. Earlier it lost that sub 40 area. So now watch whether 40 cents turns into resistance, or whether buyers can reclaim it and actually hold above it for more than one little spike. If it keeps failing at 40, that's supply talking. If it loses the mid-30s, call it 35, 36 cents, then the momentum gets a lot messier fast. AKAN now. This is the one I wanted to revisit because that $8 line is the whole story. Board's got it at about 802, up 60%, 6.5 million shares, almost 10 times average volume, and the float's only about 2.2 million. So yeah, it can move fast. But look, this is not the same as a clean breakout if it's just whipping 8, failing, reclaiming, failing again. For me, 8 is the scoreboard line. Above it, buyers are at least defending the squeeze zone. Below it, that whole momentum look gets way sloppier. And because AKAN has dilution data showing medium risk, I'm not treating this like some clean institution name. It's a tape read. If it's holding 8 with volume, fine. That's strength. If it keeps losing 8, that's a trap look, not a chase look. All right, flip it to the red side for a second. INV first, then MVIS, because the losers are ugly too. INV is sitting right near $2, down 43%. Volume's about 1.76 million, but relative volume is under 1, so this is not some crazy liquidity event like Surge or Wedo. The clean downside line is $2. If INV loses 2 and stays below it, that's where the tape can get cleaner to the downside. If 2 keeps absorbing, then shorts can get chopped up around the obvious level. Now MVIS, down about 40% at 226, and the key difference is this one has much lighter relative volume, about 0.29, with a much bigger float, so the selling pressure looks more like a heavy bleed than a tiny float air pocket. Also, dilution risk is marked high here, so that overhang matters. Between the two, INV has the cleaner psychological $2 test. MVIS has the uglier overhang but less aggressive relative volume. Good board, lots of action both ways. We'll leave the mover names there and hand it forward to the next desk.
Thanks. Markets desk, quick newsroom sweep here at the macro desk. Top story. Grub Market has filed a confidential S-1 for a U.S. IPO, with the private valuation referenced around $4.5 billion. This is not a live public trading ticker yet. So no, we're not pretending there's a chart to chase. But it matters because the IPO window is a sentiment gauge. The pitch is very 2026. AI-powered food supply chain, acquisition-heavy growth, public market test. Investors are going to care about the growth story, but also integration risk and that prior SEC settlement over revenue misstatements. AI meets produce logistics, because apparently even the avocados need a data stack now. Next up, S&P Global. We already hit the earnings pressure earlier, but the new wrinkle here is capital return. S&P Global raised its 2026 share repurchase target to more than $7 billion, which is over 5% of its market cap. That matters because management is trying to send a pretty core message. Cash flow is strong enough to lean into the stock even after the profit miss. Buybacks don't magically erase an EPS miss. Would be nice, but accounting is rude like that. But they can change the supply-demand setup in the shares. Apple is the next big one. The desk is tracking a China-specific AI model developed with Alibaba support. The headline is Apple training a large language model tailored for the China market, instead of relying only on outside models for local features. Why it matters. China is not just another iPhone region, it's a separate regulatory universe. So this is Apple trying to localize AI, defend the ecosystem, and keep the product experience tight in a market where global AI models can't just stroll in wearing sunglasses. For megacap tech, that's a real strategic fork in the road.
I've been digging into this market setup, and it's a pretty interesting tension. We've got record index levels on one side, but a softer consumer print, oil risk, and some wobble in high expectation chip names on the other. The clean version is this. The market still wants to believe in a soft landing. Demand cools just enough to help inflation and the Fed, but not enough to hurt earnings. That's the narrow path. The problem is, when indexes are at records, the margin for disappointment gets smaller. So today I want to break this into 4 buckets: consumer demand, index breadth, energy inflation risk, and then applied materials as a live example of the AI expectations problem. Let's start with retail sales. The headline number I'm looking at is a 0.6% decline in July retail and food services sales. That's not a catastrophic number on its own, but the mix matters. Weakness in autos, online retail, and electronics suggests the consumer is becoming more selective, especially around bigger ticket or discretionary categories. Now, I would not jump from 1 month of retail sales to a recession call. That's too aggressive. Year-over-year activity still looks firm, so this is more like cooling from a high base rather than a collapse. But the direction matters, because a lot of equity valuations assume the consumer stays resilient. The key question is whether this retail softness is healthy or unhealthy. Healthy cooling would mean households are still spending, but not chasing every price increase, which helps the inflation story. Unhealthy cooling would mean households are starting to pull back because savings are thinner, credit is tighter, or job confidence is fading. That distinction is huge for the Fed and for earnings. If it's healthy, the market can keep leaning into disinflation. If it's unhealthy, revenue estimates may need to come down. What I'd want to verify next is August spending data, credit card trends, consumer confidence, and whether the weakness broadens beyond those few categories. Now put that against record index levels. The S&P hitting records while retail sales soften is not automatically irrational. Markets are forward-looking, and if investors think weaker demand brings lower yields without breaking the economy, stocks can rally. But the durability depends on breadth. If the rally is mostly mega-cap tech and AI infrastructure, then the index can look much healthier than the average stock underneath. That's why I'm watching the Russell 2000, equal weight behavior, if you track it. Cyclicals, banks, home builders, and transports. A broad rally says confidence is spreading. A narrow rally says investors are hiding in the few earnings streams they trust. That brings us to the Nasdaq and AI leadership. The market has rewarded companies connected to AI compute, semiconductor equipment, networking, and data center spend because those areas still have structural demand. But at this point, good news is often not enough. Investors are asking whether results are great relative to already elevated expectations. That's a very different hurdle. A company can post strong numbers, talk about AI demand, and still trade lower if the market wanted even more. That's important because record indexes can hide expectation risk. The setup is not just about whether companies are growing. It's about whether they can keep surprising upward. Applied Materials is a good case study here. On the platform, AMAT is showing around a 5.7% decline, even though the news flow points to strong results and continued AI-related demand. The profile shows Applied as a semiconductor equipment company, basically selling the wafer fabrication tools and services that chip makers need to manufacture advanced chips. This is not a speculative pre-revenue AI story. It's a major infrastructure supplier with a market cap around $400 billion. But the valuation is not low either. The platform shows a price near $503, ES of $8.67, and a PE a little above 58, so expectations are clearly embedded. The AMAT reaction tells us something broader about this market. When a stock is priced for sustained AI capex growth, investors are not just judging the quarter, they're judging the slope of future demand. The recent headlines mention elevated expectations, strong results, and guidance that appears better than consensus in at least one write-up. But the stock is still slipping. That usually means the debate is around valuation, sustainability, margins, China exposure, or whether the strongest part of the cycle is already reflected. I'd also verify the platform's year-high and year-low range, because it's very wide, and any split adjustment or data issue matters before drawing conclusions. Looking at the AMAT headlines, one theme is that analysts still see AI demand supporting growth, while the market is reacting to how much of that growth was already priced in. That's the important distinction. A bullish analyst note is not the same thing as a low-risk setup. Semi-cap equipment is cyclical, even when the long-term theme is powerful. Spending cycles can pause, export controls can matter, China concentration can matter, and customers can digest capacity. So I'd frame AMAT less as a simple disappointment and more as a reminder. When expectations are high, the stock reaction can be harsher than the operating performance suggests. Now shift back to the macro. The Fed outlook gets complicated when retail demand cools, but inflation risks are not fully gone. Softer consumer spending should, in theory, reduce demand pressure. That gives policymakers more reason to be patient rather than lean aggressively hawkish. But inflation is not only about retail demand. Producer costs, wages, shelter, services, and energy all matter. If oil rises at the same time the consumer weakens, that is not a clean disinflationary story. It's more awkward. Lower demand helps, higher input costs hurt. That's why I'd be careful assuming one retail sales print automatically clears the path for easier policy. Oil is the wild card here. The research angle I'm focused on is risk around attacks near the Strait of Hormuz. That area matters because it is one of the most important choke points for global energy flows. Even if supply is not permanently disrupted, the market can price a geopolitical risk premium very quickly. Higher oil prices feed into gasoline, transport costs, airline costs, chemicals, and broader inflation expectations. For consumers, it acts like a tax. For companies, it can pressure margins unless they pass costs through. So oil strength alongside weaker retail sales is exactly the combination that makes the soft landing narrative more fragile. The stagflation light risk is what the market does not want to see. Slower consumption plus higher energy costs. I'm not saying that's the base case, but it's the scenario to monitor. If oil pops and treasury yields rise because inflation expectations move higher, that can pressure the same long-duration growth stocks leading the indexes. If oil pops but yields fall because growth fears dominate, that tells a different story. So the yield reaction matters as much as the oil move itself. Equities can handle some energy volatility. They have a harder time when energy volatility starts challenging the Fed path and the earnings path together. Another smaller but interesting catalyst in the mix is Reddit's expected inclusion in the S&P 500. That kind of event can create mechanical demand because index funds and benchmarked managers may need exposure. But it's important not to confuse index inclusion with a fundamental upgrade. The business does not suddenly generate more cash flow because it enters an index. What changes is the shareholder base and near-term flow dynamic. So with a name like Reddit, I'd separate the flow catalyst from the valuation debate. Mechanical buying can matter for price action, but over time, the market still comes back to revenue growth, margins, user engagement, and monetization.
Thanks, company desk. All right, markets desk is back on the movers board. And yeah, this board is still wild. SPY basically flat green, QQQ up 0.25%, IWM dead flat, VIX under 20, so the tape is not screaming risk on, but these small cap names are acting like their own little market. WETO is still the monster at the top, 1058, up 193%, 27 million shares, 600 plus relative volume. That is not normal liquidity for this thing. Capper holding the 2 spot, up about 85%. STKH still up 71, tiny float profile, so every candle can get jumpy. SURG, 41 cents, 158 million shares. Oof, that's the loudest volume number on the board. ACAN and HHS still green big as well, but I want charts now. Let's start with WETO on the 1 minute, because this is the cleanest insanity on the board. 1058 right now, up basically 193%, and the volume is the whole story. 27.6 million shares versus an average around 45,000. That is a complete regime change for the tape today. The float is about 5.7 million, so when this kind of volume shows up, the candles can overshoot both ways fast. The markets desk had that $10 reclaim on the scoreboard earlier, and right now, price is above it. That's the line I care about. Above 10, momentum traders can at least argue the breakout is still alive. Lose 10 again, and then the conversation changes from squeeze to trap really quickly. I'm not chasing the headline percent here. I'm watching whether dips hold above that round number and whether volume stays present, instead of just one burst and done.
Thanks, Markets Desk. Opening bell countdown here at the macro desk, and the tape is leaning, not screaming. We're a handful of minutes from the bell. SPY is sitting around 778.6, up 0.09%. QQQ is the leader at 733.8, up 0.23%. And IWM is basically flat at 303.5. That's the whole morning in one sentence. Mega cap growth has a bid. Small caps are still waiting for the permission slip from mom. VIX is 19.47, down about 0.75%, so the fear gauge is still under that 20 line we flagged earlier. That matters. Under 20, the market can act normal. Above 20, everybody suddenly remembers their risk limits. Cross-asset, bonds are not giving us a giant green light. TLT is down 0.24% at 82.39, while IES is barely green at 93.33. So the long end is a little heavy, the belly is steadier, and equities are saying, okay, we can live with that for now. The cleaner macro tell is outside the stock screen. Dollar's softer at 28.10, down 0.28%. Yen is firmer at 57.83. Gold is catching a bid. GLD 401.59, up 0.66%. And oil is offered with USO at 124.66, down 0.3%, just under that 124.75 marker from earlier. So the chain is pretty straightforward. Dollar eases, gold perks up, oil is not adding inflation heat right before the open, and that gives NASDAQ a little more oxygen. But don't call it a full animal spirits party, because crypto-linked risk is red. BITO down 1.17%, Coin down 1.72%, MSTR down 1.91%. That's the market saying, yeah, we'll buy some tech, but we're not putting the lampshade on our head yet. Into the bell, I'm watching QQQ 734.4 above as the first acceptance line, 733.3 below as the first support shelf, VIX 20 as the risk thermostat, and then the noon data. Retail sales at 12:30, Michigan sentiment and inflation expectations at 2. The open is going to tell us whether this is a calm, NASDAQ-led drift or just another choppy Friday wearing a nice tie.
Thanks, Macro Desk. Let's hit Eton, because this is the clean small cap momentum chart on my screen right now. All right, Markets Desk on the 1 minute. Index tape is basically asleep. SPY barely green, QQQ up a couple tenths, IWM flat, and Eton is doing its own thing. Latest movers board had this thing near 57, up around 40%. The chart packet shows the real structure. Base around 49, grindy at first, then boom. Volume actually shows up around 49.55, about 8,400 shares on that minute, and that's where the tape changes. Okay, levels. This is the whole trade map, not a recommendation, just the tape. The 49 area is the original base. The 52 area is where that late ramp really starts to matter. And 55 is the clean resistance from the 1-minute package, the old high where sellers finally clipped it. I don't have a live VWAP print in this feed, so here at the markets desk, we're using the volume shelf instead. 49 base, 52 pivot, 55 lid. Watch 55 above. If it can stay accepted over that old high, momentum still has control. But if it loses 52, oof, that starts looking less like a pause and more like profit-taking turning into a pullback. Quick catalyst check, because with small cap pharma, you do not stare at candles in a vacuum. The headline from August 5 is Eton expanding its infantile hemangioma franchise with the U.S. rights acquisition for late-stage ASN001. Then they had the Q2 results timing headline for August 13th. So yeah, there is a real pharma news backdrop here. It's not just a random ticker squeeze. Float is about 23.9 million, shares outstanding about 27.4 million, market cap around 1.4 billion. Not a subdime lottery ticket, not the same tiny float halt bait we've been warning about, but a 40% pharma gap can still air pocket fast. Dilution feed in this packet isn't giving me a live active hit. All right, markets desk back on the movers board. This thing is still loaded. SPY's barely green. QQQ's up 0.2. IWM is basically flat. VIX is lower under 1950. So yeah, don't confuse this with some huge broad market party. This board is its own animal. WETO still sitting on top, up about 188% around 1040. Capper still near 8, up 90. STKH holding the 530s, SERG doing the 40-cent penny stock circus with monster share volume. Then AKAN, HHS, ETON, INV on the red side. There's a lot here. We're not just reading percentages, we're pulling charts. Levels only. First chart has to be WETO. Pull it up. This is the score leader. $10 and change, up huge, 28+ million shares already, and relative volume is just absurd. Over 600 times normal. Oof. But here's the thing. The $10 reclaim already paid us as a level earlier, so I'm not treating 10 like some magic breakout now. Now the cleaner question is this. Can it actually accept over 1050? Or is this just chopping above the round number before the trapdoor opens? If 10 fails clean, momentum gets messy fast. If 1050 starts holding with real 1-minute volume, then the tape's still alive. Tiny float, China Mobility / software name, violent tape, so this is not a casual chart. It's a level chart.
All right, there's the opening bell. Let's call the whole tape before the confetti hits the floor. SPY's at 778.51, up 0.08%. QQQ 733.08, up 0.14%. IWM 303.37, just read by 0.04%. The Dow quote isn't printing on this portal tile for me, so I'm not going to freestyle it. MacroDesk does enough guessing before coffee as it is. But the message is pretty clear. This is a tiny NASDAQ-led green open, not a broad market stampede. VIX is 19.45, down 0.87%, so volatility is still under 20, and the risk thermostat is cooler. But breadth is mixed. So don't confuse a green megacap headline with everybody joining the party. And QQQ is opening underneath that 734.40 acceptance line we had queued, with the low 733s still the first shelf. That's the whole morning in one little box. Can tech reclaim the upper 734s? Or is this just a polite opening pop with weak knees? Now, the first movers out of the gate. The index tape is quiet, but the alley behind the exchange is doing carnival rides. Weto is still the fireworks name, up about 195% at 10.65 with 642 times relative volume. STKH up 82.6% at 5.26. Capper up 75.8% near 7.40 after that earlier squeeze. SERG up 59% around 39 cents. AKAN up 57.7% near 790. HHS up 50% around 4.22. Then on the other side, INV is down 43.8% near $2. MVIS down 38.7%. So here's the read. Traders are chasing very specific catalysts, but they're not buying the whole small cap complex. Russell is still slightly red. That's selective risk appetite, not a full green light. Agenda from here: does NASDAQ broaden? Does VIX stay below 20? And do we get actual macro confirmation later with retail sales at 12:30 and Michigan sentiment at 2? Or is this just opening bell caffeine wearing a nice jacket? Okay, cross-asset check real quick, because this is where the open either gets confirmed or it starts looking a little wobbly. Bonds are not giving you one clean story yet. TLT's down about 0.4, but IEF is basically flat, tiny green. So the long end is still a little heavy, but the belly isn't exactly screaming panic. Dollar's softer, down about 0.3. Yen's firmer by 0.5%. Gold's up almost 0.8, and oil's lower. That mix is a little defensive, honestly. Softer dollar helps risk. Gold and yen firming says there's still some safety bid, and lower oil takes a little inflation heat off the screen. Now, crypto proxies are not helping the animal spirit side. BITO down 1.2%, Coin down almost 1.9%, MSTR down 2.3%. So, yeah, NASDAQ's green, but crypto beta is red. That matters. Let's drop it back to QQQ for the actual morning map. VIX is still around 19.5, not exploding, but not asleep either. QQQ's range is tight. 734.40-ish is the top of the morning. 733.30 to 733.45 is where buyers have been trying to defend. Above 734.40, you've got a cleaner upside push. Below 733.30, that opening base starts to fail. Calendar-wise, stay alert for the scheduled data on deck, because with a tape this compressed, one macro headline can move the whole thing. All right, that's the opening macro math. Next, we're going to hand it toward the movers and see where the real heat is hiding.
Thanks. Macro desk. Quick tool check, because this is the whole board we're trading off here at the markets desk. These movers, the gainers, the losers, the relative volume flags, the float context when it's there, that's ProTerminal. And just to be clear, the board is not a buy list. It's a research radar. Weto, STKH, SURG, all of these are screaming for attention because the tape is loud. Then we decide if the chart actually backs it up. Now this tab, right here, Dilution Center, super important on the small cap stuff. Oof, this is where a lot of people get smoked if they only stare at the green candle. You want to know, is there a shelf? Is there an ATM? Was there a recent offering? Could supply hit the tape? It doesn't mean a stock can't run. It means you actually know the risk sitting behind the move. Data can be incomplete or delayed sometimes, so you still verify. But this is where I want my first risk check. Let's use Surge as the example. On the stock profile, I can jump straight into filings, press releases, insider activity, all the stuff that tells me why the stock might be moving and whether there's anything ugly hiding underneath. I don't need 10 tabs open. I need the headline, the filing, the timestamp, and then I need to get back to the tape. That's the workflow. Catalyst first, risk check second. Chart confirms or denies it. And then, boom, right back to the 1-minute chart. This is where the markets desk lives. Candles, volume bursts, failed wicks, VWAP fights, the actual bid-offer story. The platform's just giving us the data cleanly. It's still educational. It's still on you to handle risk. And nobody should treat a hot mover like a guaranteed trade. If you want the same setup we're using on stream, movers, charts, dilution, filings, insider data, sign up at proterminal.io. Coming up, we'll flip right back into the mover scan.
All right, markets desk back on the movers board, because the tape is basically flat and this board is still completely wild. SPY barely green, QQQ barely green, IWM barely green, VIX under 20, breadth mixed. So yeah, relative strength matters, but so does who's already starting to fail. Weto's still top row, up about 150%. But scorekeeping here, that $10 line we flagged is not clean anymore. Board's showing around 902. STKH still ridiculous, up 112% near $6. Tiny float, monster turnover. MDXH is the new one forcing attention. 84 cents, up 82%. Relative volume, over 80. Capper's still green, but we already got that downside hit earlier. AKAN, Surge, HHS all still on the hot side. And then look at the red side. IMV down 46, CXAI down 43. Not every volume spike is a squeeze. Some of these are just air pockets. Let's pull Weto first, because this is the scoreboard name. Oof, look at the risk here. Top gainer, yes, but the markets desk flagged $10 as the messy line, and now we're living below it. That changes the read. When a stock is still up around 150%, but it loses the clean round number that fast, I don't care how pretty the gain column looks. Now I'm watching whether 9 becomes an actual shelf, or if it's just a speed bump on the fade. Board price is around 902, volume already over 30 million, relative volume 674, float about 5.7 million. That is monster turnover versus the supply. It can whip both ways. To repair the momentum look, 10 has to get reclaimed. Under 9, the fade starts looking way more organized. So Weto map right now, 10 reclaim above, 9 fail below. STKH next, and this is a totally different flavor than Weto. We're sitting right around that $6 area, up about 112%. But the key detail is the float, under 500,000 shares reported. That is tiny. So yeah, 18 million shares traded is a monster tape, but with a float like that, the candles can look beautiful for 30 seconds, and then one seller prints a full nasty wick. What I want to see here is volume actually holding the bid around 6. Not just these vertical pops that immediately reject. If STKH can stay above that $6 line, fine, momentum's still alive. If it keeps wicking through it, that's where this starts looking more like chase and trap than clean continuation. Now, MDXH, healthcare diagnostics name, 84 cents, up about 82%. And this one's doing it on real volume too, 15.4 million shares versus normal volume under 200,000. So relative volume is over 80 times. But big difference from STKH, this is still a sub-dollar healthcare tape with high dilution risk on the board. So you don't treat every green candle like it's clean institutional accumulation. The line for me is pretty simple. 80 cents needs to stay defended. If 80 cents keeps holding, traders are going to stare at that $1 magnet all morning because penny stock psychology is real. But if it loses 80 and can't reclaim it quickly, that's where the move can turn into a VWAP-style fade pretty fast. Capper, now. And I'm not going to relitigate that earlier fight, because the cleaner read is what happened after the pop. This is still up 73%, 25 million shares traded, so it's not some sleepy biotech print. But the question right here is stabilization. Around 730, that's the spot I care about on the 1 minute. If buyers keep absorbing dips there, okay, you've got a base trying to form after the squeeze. If 730 starts slipping and the candles can't reclaim it, then this gets a lot more chasey and a lot more fragile. So Capper's not dead on the tape. It's just moved from breakout mode into can buyers actually defend the shelf mode. AKAN next. This is the cannabis-related momentum name, and yeah, this one can get jumpy fast. Price is sitting around 850, up about 70%, 7.4 million shares traded, and the float profile is tiny, just over 2 million shares, so every volume burst matters. But with that, you also get the ugly stuff: wick risk, halt risk, and those sudden air pockets where a green candle turns into a trap in 2 minutes. The read for me is simple. If it's holding the 850 area with volume still coming in, momentum traders are still paying attention. If it keeps poking above and instantly rejecting, that's where I'd call it more of a headline squeeze than a clean continuation tape. Respect the range on this one. It can move $1 before you finish blinking. Last one on the green side I want on the 1 minute is Surge, because this is the loudest volume print on the whole board. 176 million shares, relative volume over 1,300 times normal, and it's still only a 38-cent stock. So yeah, huge tape, but high dilution risk, sub-dollar mechanics, and this is exactly where you don't chase candles just because the percentage is green. The read for me is simple. If it keeps popping and failing back under VWAP, that's the trap version. Volume is massive, but buyers aren't controlling it. If it can actually reclaim and hold the middle of the range, then you've got continuation attempts, but it has to prove it. Now flip the board red for a second. INV almost cut in half, down 46% around $1.94. That's downside momentum, not just a little dip. CXAI is even nastier looking on the percentage board, down 43% and sitting basically on the dime area at 10 cents. If that 10-cent line cracks, that's where the risk it's really grows fast. Quick board check before we hand off. DAAQ is up 43, but only about 51,000 shares, so I'm not treating that the same way as a Surge or Weto volume event. HHS Cleaner Liquidity, up 46 on about 2.4 million shares, worth keeping on the side screen. Alright, good movers pass. We've got the small cap chaos mapped out, and now we're handing it over to Mega Cap Watch to see what the real leadership names are doing against this flat tape. Alright, quick Mega Cap check. Let's pull up JPM, because the banks are actually giving us a clean chart, while the tape is mixed. Okay, daily chart first. This is not a messy chart. JPM has been stair-stepping higher from that old 295 zone. Then it broke through the 330s, held the pullbacks, and now it's pressing right back into the high end of the range. The daily candle work has the key high up around 366.09, and current chart read is sitting around 364.79. So yeah, this is knocking on the door. But here's the thing. The move into the mid-360s is coming on lighter volume than the prior breakout push. That doesn't kill the setup, but it means the market's desk is not blindly cheering it. I want to see acceptance near the highs. Watch 366.09 above. That's the daily breakout door. If it rejects there, then 350 is the bigger daily shelf underneath. Clean. Simple. No need to overcomplicate it. Now let's drop down to the 1 minute, because this is where you can see whether buyers are actually paying up at the open. And oof, look at that structure. Open around 362.89. Quick hold near 362.85, then higher highs, higher lows, and the push through 363.40 had real volume behind it. That's the tell, not just a drift. You got those 35K to 85K share bursts on the breakout area, then a tight reset, then another push toward 364.93. Current read is basically sitting right under the high, around 364.79. So, for the intraday map, I'm flagging 364.93. Call it 365. Above for acceptance. Below, 363 matters. If JPM loses that 363 shelf, the morning breakout starts looking more like a failed push than clean leadership. And put it against the tape. SPY is basically flat, QQQ barely green, IWM red, breadth mixed. So JPM holding near highs is relative strength, especially for a bank, not some tiny float runner. The daily says breakout pressure. The 1 minute says buyers defended the open and paid up through 363.40. But the scorecard is tight. Above 365 needs follow-through. Below 363, and you respect the fade risk. Coming up, we'll rotate back through the movers board and see if the small cap heat is still holding, or if the mega caps are taking the wheel. Alright, let's hit the movers board and see what's still got real volume after that mega cap lap. Tape is basically sideways. SPY barely green, QQQ leading a bit, IWM flat, VIX under 1950. So when WETO is still up 152% on 700 times relative volume, that's not broad market beta, that's pure event momentum. MDXH right behind it, up 103%, 44 million shares, sub-dollar and still trying to stay bid. STKH is hanging around 5 after the tiny float explosion. CAPPR is giving back some of the biotech pop. AKN is slipping under 8 now. So here at the markets desk, this lap is simple. Not just what's green, what's holding bid after the first 15 minutes, and what's just a wick factory. Let's pull WETO first, because this is the scoreboard name. Up 152%, last around 9/11. 31.8 million shares against a 45,000 average. I mean, that's silly volume, but the score from earlier still matters. $10 broke, that hit was real, and now the chart has to prove buyers exist under the break. Oof, look at that wick structure. This is exactly why the board can look clean and the 1 minute can look nasty. Float's about 5.7 million, so these candles can stretch both ways. Back through 10 is repair. Losing 9 clean makes the fade way more organized. I'm not calling it dead with 700 times relative volume, but right here, the bid has to do work.
Thanks, Markets Desk. Breaking oil headline here from the macro desk, and this one matters for the whole energy map. ProTerminal's newsroom is tracking India taking a record 50.83% of its July oil imports from Russia. That's 2.47 million barrels per day. So what we know, this is a major share shift in physical crude flows, and it keeps showing how the oil market is getting rerouted, not simplified. What we don't know yet, the exact discounting, the shipping mix, and whether this July pattern carries into August. Market read right now? Oil is not screaming higher on it. Crude exposure on our board is around 124.50, down about 0.4. So the tape is treating this less like a supply shock and more like a trade flow headline. Still big. Energy is geopolitics with invoices attached, basically. Next headline. The consumer data is the macro tripwire today. The desk is tracking July retail sales and Michigan consumer sentiment because that is where the rates market gets its little espresso shot, wanted or not. The retail sales setup had consensus at plus 0.1% month over month. And today's calendar is carrying a weaker headline read at negative 0.6%, with ex-autos at negative 0.3%. versus a plus 0.2% estimate. Michigan sentiment is still on the board for 2 p.m. Eastern, estimate 54.5. Why it matters? If the consumer is cooling while yields are still sticky, equities don't get a clean story. SPY is basically flat near 778. QQQ is still green near 734. So for now, the market is absorbing it, not panicking. And the third story is the bond market pressure that sits underneath all of this. ProTerminal is tracking the continued U.S. Treasury sell-off risk, higher funding costs, tighter financial conditions, and more volatility bleeding into stocks. On the screen, the key thing is not some grand theory, it's the tape. TLT is around 82.23, down 0.44%, while IEF is basically flat near 93.33. That tells you the long end is still where the stress lives. Gold is up near 402, dollar is softer, and VIX is just under 19.5. So investors are hedging a bit without smashing the red button. The bond market is the smoke alarm, annoying, early, and usually worth listening to. Coming up, we kick it back toward the mover scan and see which single names are actually paying attention.
Let's talk. China expands national security review on tech outbound investment. The names actually carrying it right now: NVDA and the rest of the group, AVGO, MRVL, AMD. The headline driving it: China to expand national security review to outbound investment in tech semiconductors. I'm pulling up NVDA first to read the tape. Then we'll rotate through the others. Who's leading? Who's lagging? Whether the whole group's moving together. This is the theme and the price action, not a call on any of them. Alright, company desk here. Let's connect Apple's $60 billion Texas manufacturing headline to the AI chip names actually trading on the screen. We're starting with NVIDIA, because look, if the market is going to price a domestic AI hardware build-out, NVDA is usually the first place traders check. Tape is mixed, but not heavy. QQQ up about 0.2, VIX under 20, and NVDA is green by roughly 0.6, around 226.70. So, the first question is simple. Is this real leadership, or just another headline getting layered onto an already crowded AI trade?
Thanks, Company Desk. Quick Stock Whisperer check-in on the simulated paper book. I just opened Capper Long, 600 shares, and the whole idea is very simple. FDA data review momentum, reclaiming 7.25, small starter, defined risk. I'm not chasing the percent move here. Capper's already up big on the movers board. I'm testing whether that 7.25 reclaim can actually hold. If it rolls back under 7.05, that's my failed reclaim warning zone. If it can build and clear 7.75, then I've got confirmation that momentum buyers are still in control. Again, this is the show's paper portfolio, not something to copy. Rest of the book is steady. F is green about 66 bucks. NFLX is up about 51. PYPL's the best open winner right now, up about 136. SPGI, that's the short, basically flat but slightly green, and XOM is a tiny red down about 4 bucks. Cash is just under 50 grand, so I'm not max swinging the account here. On the orders side, I've still got brackets working in NFLX, PYPL, and SPGI, plus that Capper level-based entry logic. Coming up, we'll flip back to the mover scan and see if Capper is actually holding that reclaim or if this turns into a fast fade. Thanks, Company Desk. Markets Desk is jumping straight back to the movers board. All right, tape is green but sleepy. SPY barely positive, QQQ up 0.2, IWM up a quarter point, VIX under 1950. So when WETO is still up 187%, that is not the market dragging it higher. That's its own animal. MDXH is still hanging around plus 125, CAPR plus 75, STKH plus 60, HHS plus 50. Then red side, oof. INV and MVIS are getting hit hard. The job here is simple. Don't worship the percent move. Check the 1 minute. Is volume still paying buyers, or are these just exhaustion wicks? First chart is WETO because that $10 reclaim we flagged earlier actually hit, and now the board has it around 1037. 10 bucks is the line I care about. All right, WETO on the 1 minute. This is the tape check, not the victory lap. Earlier, it punched back through 10 after that failed round number look, and now it's still above it. That matters. If this keeps holding over 10, buyers are at least defending the repair. If it slips back under 10 and can't snap back, that's where this starts looking like a trap instead of continuation. And with a 5.7 million share float, 32 million shares already traded, this thing can squeeze both ways fast. Oof, that's the part people forget. Multiple float turns can look amazing on the way up, and brutal when the bid thins out. So here at the markets desk, I'm not forcing some fancy read. 10 is the fail line. 1030s are the current battleground, and any hard rejection back through the round number changes the tone quick. MDXH now, and this one is basically the dollar reclaim test in real time. Stock sitting just over $1, up about 125%, and the volume is not subtle. 68 million shares, roughly 368 times normal. So yeah, the tape found it. But here's the catch. This is healthcare diagnostics, 35.7 million float, and the dilution risk tag is high. So I don't want to treat every green candle like it's clean institutional accumulation. For me, the first line is simple. Does $1 stay reclaimed, or was that just a squeeze through a psychological number? Above $1, bulls can keep defending the round number bid. If it starts living back below 1, that changes the feel fast. Capper next, biotech follow-up, and yep, that 730 downside level we were watching just got paid. Clean tag. Now I'm not doing the victory lap on a red candle, I'm watching the reaction after the hit. It's still up about 75% on the day, price right around 735, volume over 31 million, so there's still real liquidity here, but the character changes if the bounce off 730 is weak. What I want to see is whether buyers can stop the bleed and start holding above that area. or if every pop is getting sold into. Stabilization first, reclaim second. If 730 keeps cracking, then this stops looking like digestion and starts looking more like a deeper fade. STKH now. And this is exactly where I don't want to over-romanticize the move. It's up 62%, 21 million shares traded, but look at the float, under 500,000 shares. That is tiny. So for me, this is a wick versus follow-through check. When a name is this thin, it can look amazing for 3 candles and then completely rug the same range. Price is around 468, so I'm watching whether it can actually build above 480, or if every push just gets sold back into the mid-4s. Below 450, the momentum look gets a lot shakier. Not saying it has to fail, just saying tiny float plus huge relative volume means you respect every wick. HHS first. Then I'll flip ONFO right after it because these two are both mid-board gainers, but they're not the same tape. HHS is up about 53%, around 429, and the liquidity is decent but not insane. 2.7 million shares, 26 times normal volume, float just under 4 million. That's more of a controlled range read. Can it keep accepting above 420? Can it reclaim 430 cleanly, or does it start bleeding back toward $4? Now ONFO, this one has way more raw volume, over 10 million shares, up 48%, trading around 341. So ONFO is the heavier tape, but also the messier one for me, because dilution risk is marked high, and you've got a 5 million share flow turning over hard. I'm watching 350 as the upside line there. If bids keep stepping up through that, okay, it's still awake. If it keeps rejecting and loses 340, that's where it starts looking more like churn than momentum. All right, quick red side check now. INV first, then MVIS. INV is down almost 49%, and the big thing here is whether this is actually trying to base around the high 180s, or if every little bounce is just getting sold into. When a stock is cut in half on the day, I'm not trying to be a hero on the first green candle. I want to see if it can reclaim that 190 area and actually hold it. MVIS is the same idea, but cleaner psychologically because it's sitting right under $2. That $2 line matters just because everybody can see it. If it's below 2 and the pops keep failing there, sellers are still in control. If it can get back above 2 and stay there, then okay, maybe you get a better bounce attempt. But right now, this is still a damaged chart, not a pretty reversal. Speed round on the green side to close it. AKAN, nice move, but it's a thinner small cap tape, so I'm watching whether it can keep accepting above 730, 740, instead of whipping right back through it. And SERG, monster volume, over 200 million shares, up 45%, but it's still a 36-cent stock with high dilution risk on the board, so don't treat that like some clean blue chip breakout. On SERG, that 36-cent area is the whole fight. Hold above it and momentum traders stay interested. Lose it and this can turn into a churn fest fast. Good movers scan there. We hit the leaders, we hit the fades, and now I'm going to pivot us off the board and into the next headline check so we can see what's actually feeding this tape. All right, back to the movers board, because the indexes are basically sleepy, and this board is absolutely not. SPY's flat, Q's barely green, IWM's got a tiny bid, VIX is under 20. Mixed tape, nothing crazy there. But look at this board. WEDO's still parked at the top, almost a triple on the day. MDXH, still hanging around after that monster liquidity burst. Capper, oof, that one's important because we already saw that downside level get hit earlier, and now it's trying to figure out if buyers are still around. STKH is still spicy, still wick heavy. Then surge down here, that relative volume is just stupid. Over 1,500 times normal. So here at the markets desk, this is not a percent gain victory lap. This is levels, volume, and who's still actually holding a bid after the open chase. Let's pull WETO first. This is the one the board is making us respect. We flagged that $10 reclaim earlier. That hit. And now the question is way cleaner. Can it actually build above 10? Or was that just another squeeze wick? Price is around 1037 on the board. Volume is already massive. And with only about a 5.7 million float showing, every candle gets exaggerated. So I'm not chasing the headline number here. I'm watching the structure. If buyers can chew through the 1080 area and not instantly reject, that tells you the bid is still aggressive. If it starts living back under 10, totally different look. That's failed reclaim territory. And look, WETO has filings and dilution data on the platform, so this is exactly the kind of small cap runner where the chart can look beautiful for 30 seconds and still absolutely rug people if liquidity turns. Fast tape. MDXH next. And this is the important part, because after a squeeze like this, the chart can look amazing for about 5 minutes and then just start bleeding. We're sitting around 93 cents, still up 100% on the day, and the volume is not fake. 74 million shares, almost 400 times normal volume. So the question is super simple now. Are buyers actually defending the 90-cent area, or is this just churn after the move? I'd want to see it stay clean above 90, because once these sub-dollar healthcare names start losing that round number bid, the tape gets slippery fast. Also, dilution data is on here and the risk tag is high. So yeah, respect the momentum, but don't treat this like a clean large cap breakout. Now, CAPR. This one's different. Bigger biotech, not the same micro float circus. But we did get that downside level hit earlier, so now I'm checking the quality of the bounce, not just the headline percent gained. Price is around 689, still up 63%, and volume's heavy at about 32 million shares. But the relative volume is only 7.5 times normal. Strong, just not that insane WETO or MDXH type print. For the FDA momentum crowd, $7 is the emotional line right above it. If buyers can keep reclaiming that area, okay, they're still defending the story. If it keeps rejecting under 7 and starts living below 680, that tells you the chase is getting tired and the earlier downside hit mattered. So CAPR's still alive, but it's not automatic continuation. This needs buyers to prove it again. STKH now, and this is where the board gets really spicy. Current print is basically $4.50, up about 56%. But look at the share structure here. Float shown under 500,000 shares. That's tiny. So yeah, 21 million shares traded sounds awesome. 200 plus relative volume sounds awesome. But with a float that small, every candle can turn into a wick machine. The level I care about is simple. This 450 area. Earlier it had that $5 fight. Couldn't really make that clean extension stick. And now the question is whether 450 is actually stabilizing or whether it's just pausing before another flush. If it starts living below 450, I don't want to pretend that's strength. If it reclaims 5 with volume, different conversation. But right here, this is ultra small float tape, not a clean sleepy trend. SERG next. Totally different price bucket, but maybe even crazier volume. This thing's 36 cents, up about 47%, and it's already traded over 200 million shares. Relative volume is showing over 1,500 times normal, which is just ridiculous. Now, because its sub-dollar and dilution risk is marked high, I'm not treating this like some clean institutional breakout. This is liquidity, churn, and crowd momentum. The clean version is it keeps holding that mid-30-cent zone and buyers keep absorbing dips. The ugly version is it keeps popping over 38-40 cents and immediately giving it back. That's churn, that's late chase getting fed into. So for me, clean holds matter way more than the headline percent gain here. If 36 cents keeps holding, the tape still has structure. If it loses that and volume stays heavy, that's when the move can get messy fast. ONFO and HHS rapid fire here. Then we'll check the red side. ONFO first, 343, up about 48%, 11 million shares traded, roughly 20 times normal volume. This one's got enough liquidity to be interesting, but it's also tagged high dilution risk, so I'm not treating it like some clean institution quality breakout. For me, the cleaner look is if it can keep accepting above that 340 area instead of instantly stuffing every push. Now flip HHS, 429, up 52%, but only about 2.7 million shares traded. Relative volume is strong, float small, but this feels more like thin chase behavior than ONFO. If HHS starts giving back those pops, I don't want to romanticize it just because the percentage gain is big. Quick red side sanity check. INV is ugly, down 49% at $1.83, but the volume isn't some market-wide panic tell. That feels isolated. MVIS, same idea, down 46 near $2, but relative volume's only about 1.2, so I'm not seeing that as the whole risk board breaking. And then AKAN is the last high beta gainer, 730, up 46, low float, cannabis name, medium dilution risk. Fun tape, sure, But if $7 starts failing, that can turn from momentum to air pocket really fast. So net-net, the board is still risk on, not risk off. Weto's still the star. ONFO looks cleaner than HHS to me, and the losers look more single name than contagious. Alright, coming up next, let's shift off the speed board and hit the next story driving the tape.
Thanks, Markets Desk. Quick macro check on why this tape is so calm while the data's not. Here's the wide-angle shot. SPY is sitting around 778.4, up just 0.07%. QQQ up 0.18%, IWM up 0.22%, and VIX is down near 19.50. So that's not panic. That's the market sipping coffee and pretending it didn't see the receipt. The retail sales print on the board is weak. Headline down 0.6% versus a plus 0.1% estimate. X-autos down 0.3% versus plus 0.2%. Growth side, softer. But the rate side is not exactly sending flowers. TLT is down 0.38% around 82.27. IEF basically flat near 93.29. So equities are saying, okay, maybe slow down, but manageable. Bonds are saying, yeah, and higher for longer still has a key to the apartment. That's the whole tension in the tape right now. Now zoom out one more click, because this is where the cross-asset stuff actually matters. The dollar proxy is lower, down 0.41%, around 28.07, while the yen proxy is catching a bid, up 0.40%, around 57.76. Softer dollar, gold likes that. GLD is up about 0.9%, near 402.56. Oil is going the other way. USO down 0.53%, around 124.37. So the inflation scare from crude is not the thing pushing buttons this morning. That's a little relief valve for equities. But gold being bid while VIX is lower tells you this is not full cowboy risk on. It's more like nobody's screaming, but everybody still knows where the exits are. And even if you only trade US stocks, keep one eye on the yen and the long bond here. When FX and duration start moving together, mega cap multiples usually notice before the headline reader does. Macro is plumbing, boring right up until the basement floods.
Thanks, Macro Desk. Let's pull up the Stock Whisperer book and slow this down for a second. This is the show's simulated $100,000 paper portfolio. And right now, the planned action is actually no action. Tape is modestly green, SPY a touch higher, QQQ green, IWM green, but breadth is mixed. So this is not the spot where I start chasing every hot mover just because the board is loud. First, bit of housekeeping. CAPR is not in the open book anymore. We took that small paper starter earlier on the 725 reclaim, and when it failed the 705 warning level, I cut it. That's not glamorous, but that's the job. Thesis, level, defined risk. And when the level breaks, the Stock Whisperer doesn't sit there hoping. Current open book is 5 positions: F, NFLX, PYPL, SPGI, and XOM. Add the live mocks together, and the open unrealized P&L is about $201 green. Small, controlled, and honestly, that's fine for this tape. Alright, Ford first. F is a long 600 shares from 1385, marked 1396 right now. That's up about $66, roughly 0.8%. Not a monster, not supposed to be a monster. It's a steady position and it's behaving. Then NFLX, long 100 shares from 77.9577, marked 77.94, down $1.77. Basically flat. And when a position is basically flat, I don't invent drama around it. There's no fresh trigger here, no reason to force a button press just because we're live. PYPL is the cleanest open winner in the paper book right now. Long 150 shares from 59.6199, marked 60.53. That's up $136 and change, about 1.5%. So the question here is not, how do I get aggressive? The question is the original trade still doing its job? And right now, yes, it is. I'm not adding, I'm not moving pieces around on air without a new level. I'm just letting the clean one stay clean. Now the hedge style piece. SPGI is short 20 shares from 424.15.5, marked 423.95. That's up $4.10. Tiny cushion, not a victory lap. Then XOM is long 60 from 159.28, marked 159.22, down 360, basically flat. And tying it back to what the macro desk just flagged, the oil flow headline is interesting, but interesting is not the same thing as executable. XOM is not getting touched from this mark just because the story is moving across the screen. Now, let's flip to the watch levels. I've got 3 upside triggers, but these are triggers, not tickets. AAPL above 308.50 is the headline continuation level if it can clear opening supply with market support. MSFT above 500 is the clean round number reclaim I'd care about for AI catalyst momentum. And NVDA above 227.50 is the semi-momentum check, but only if QQQ is firm with it. If those don't hit clean, the paper book does nothing. That's the whole point of having the level before the emotion shows up. So, final decision from the Stock Whisperer session, no live paper trade here. AAPL and MSFT have catalysts. NVDA is still on the growth watch, and the small cap movers are extended enough that I'm not paying up just to participate. This simulated book stays disciplined. Coming up, the news intermission can sort through the headline flow. I'm leaving the paper portfolio on process, not impulse.
All right, quick news check. Here are the headlines moving markets right now. OnFolio Holdings announces 1-for-50 reverse stock split to regain NASDAQ compliance. OnFolio Holdings announced a 1-for-50 reverse stock split to regain NASDAQ listing compliance, reducing its float to about 850,000 shares. The company is also exploring strategic alternatives, including acquisitions and asset sales. Why it matters: the reverse split aims to stabilize the stock and meet listing rules, while strategic moves could reshape the company's portfolio and improve earnings quality over time. Waytour Robotics advances warehouse robotics with cooperation agreement and Qualcomm partnership. Waytour Robotics announced a warehouse robotics cooperation agreement expected to generate about $5 million in gross profit, and joined the Qualcomm Partner Network to evaluate Dragonwing technologies for industrial AI and IoT applications. Why it matters? These developments could accelerate Waytour's commercial rollout and technology integration, potentially enhancing its competitive position in physical AI and robotics.
Thanks, Macro Desk. All right, Markets Desk is back on the movers board. And yeah, this is still a stock picker tape. SPY basically flat, QQQ barely green, IWM a little firmer, VIX parked near 19.5. So when you've got names up 50, 80, 100+%, that's not the index dragging them. That's flow. WETO is still the headline on the green side. Capper is still sitting hot after that wild biotech move. OnFo is holding in the top stack, and MDXH is still trading like the crowd hasn't left yet. Oof. And look at Surge down there. Huge volume names still green, but that earlier 40-cent call out is still the real scoreboard for me. I'm not chasing a percentage board. I want the chart. First up, WETO. Okay, WETO on the 1 minute. This is the kind of move where the first question is not, is it up a lot? We know it is. It's up about 160%, trading around 946. And the relative volume is just silly, 800+ times normal. The question is, does the bid keep defending pullbacks, or does it turn into one of those straight-up, straight-down traps? Float's about 5.7 million, so it can move fast both ways. For me, the clean momentum check is the $10 area above. Big psychological level, obvious tape level. If it can push through 10 without instantly stuffing, that's where continuation traders start paying attention. But below 9, that's where I'd say the move starts losing rhythm. Not a cozy name, not a slow name. This is a thin, high beta runner, so the wick risk is real. KPR next, and this one's a different flavor from WETO. Biotech, bigger float, cleaner dollar volume, and it's still up about 92% with 37 million shares already through. The spot I care about is that $8 area. Not because 8 is magic, but because when a stock goes from total momentum into a cleaner consolidation, whole dollars become the crowd's scoreboard. If KPR can keep reclaiming 8 and holding above it on pullbacks, that tells you buyers are still defending the move instead of just chasing the headline. If it starts accepting below 8, then yeah, that momentum read changes fast. And with the indices basically flat, this kind of relative strength is obvious. But biotech can flip hard, so I'm watching behavior, not just the green number.
Thanks, Markets Desk. Quick Stock Whisperer check-in on the simulated paper book, because we just added GS short. This is the broadcast paper portfolio, not a copy this trade. 10 shares short, average 1038.24, marked around 1037.14 right now, so basically just green by about $11. The thesis is simple. Fresh negative earnings catalyst, profit shortfall, fixed income revenue pressure, and in a mixed tape. SPY and QQQ basically flat. I'm looking for follow-through selling, only if GS stays offered below that post-news supply area. If it snaps back above the risk line, I don't argue with it. Here's the bracket. The buy stop is sitting at 1064. That's the line where the short thesis is wrong for me on this paper setup. The take profit order is down at 988, so the risk is defined before the trade ever gets emotional. Rest of the book, F is still the biggest green open position. SPGI is working on the short side, PYPL and NFLX are small green longs. Cash is about 69,000, so I'm not maxed out, but I'm also not forcing anything with Michigan sentiment still coming at 2 p.m. Coming up, we'll flip back to the movers scan and see where the live tape is actually rewarding momentum.
Thanks, Stock Whisperer. Let's pull up Google and do the mega cap chart check. All right, daily chart first. This is not a moonshot chart. This is a base attempt. Big difference. Markets basically flat. SPY flat, QQQ just a hair red, and Alphabet is hanging around the 348 area after that ugly sell-off phase. So here at the Markets Desk, we're asking one thing. Is this actually rebuilding, or is it just bouncing into supply? On the daily, you can see the damage and the repair attempt at the same time. Earlier move was clean. Higher lows, breakout through the mid-350s, extension all the way toward that 385 area, and volume confirmed it. Then the sell-off came in hard. Heavy volume on the downside, price washed into the low 310s, and now we're not back in an uptrend yet. We're basing. That matters. Current action is this tight little 345 to 350-ish zone, and the bigger lid is still around 360. Until Google can clear that 360 area, this daily is still lower half of the range behavior. Underneath, the 200-day zone around 331 is the longer-term reference, and the deeper daily support from the candle work is closer to 315. So, the scorecard level for me, Google above 360 is the daily reclaim area. Below that, it's still a fragile base, not a confirmed trend. Now let's drop down to the 1 minute, because this is where it gets more interesting. The open was sleepy. Google started around 346.78, chopped sideways, made a little lower low sequence into roughly 345.54. Nothing special. Then boom, the character changed. Pushed through 347.60. Volume spike around 275k shares. Then the tape accelerates straight into 350.45. That's the actual intraday breakout. Right now, it's not extending, it's digesting. Price is sitting around 348.2, 348.4, and volume has tapered. That's a flag look. Not a guarantee, just structure. For the live levels, 350.45 is the high of day trigger area above, and 348 is the must-hold area below. If 348 cracks and accepts under it, that breakout starts looking more like a failed push. If 350.45 clears with volume, then the buyers are still in control intraday. Quick catalyst check on Alphabet, and honestly, the recent press release stack is not the driver I'd lean on here. We've got multiple investor alert and law firm investigation headlines over the last few days. That can create headline noise, sure, but that is not the same as a clean operating catalyst like cloud numbers, ad growth, AI product news, or earnings. So for this specific morning, the chart is doing most of the talking. Google is trying to hold a post-breakout base while QQQ is slightly red and breadth is mixed. That's decent relative action, but not a victory lap. Keep 348 and 350.45 on the board. Coming up, we'll swing right back to the movers scan and see where the actual high beta money is rotating. All right, let's hit the movers board because the indexes are doing almost nothing and this board is still loud. SPY basically flat, QQQ flat, IWM green by about 0.3, VIX still hanging near 19.5. So this is not some huge broad market squeeze. This is pockets, very specific pockets. WETO still sitting at the top, up around 148%. MF right behind it, huge percentage move, but way thinner. CAPR still holding that big biotech gap. MDXH, the penny stock volume monster, still on the board. AKAN in there too. So here at the markets desk, I don't want the prettiest story. I want the cleanest 1-minute tape. First job, see which of these is still building, and which one is just recycling late buyers. WETO first. Pulling up the 1 minute, and yup, this is exactly why we keep score on levels. That $9 line we flagged earlier, price is sitting just under it now, around $8.97 on the board data. So the move is still massive, no question, but the rhythm changed. Up 148% with roughly 40 million shares traded on a name that normally does nowhere near that. That's real attention. But after a run like this, under 9 is not the same tape as cleanly holding above 9. If it reclaims 9 fast, fine. The crowd gets another chance to prove they're still defending it. If it keeps accepting below 9, I'm watching 850 as the next downside check. Not a prediction, just the next level where I want to see whether buyers actually show up, or whether this turns into that low float air pocket trade. Oof. And with a 5.7 million share float, you can get violent candles both ways. No chasing blindly here. MF next, pulling up the 1 minute here, because this is the one where you really have to separate squeeze continuation from just late chase nonsense. Stocks around 1870, up 87%, about 1.4 million shares traded, roughly 15.8 times normal volume. So yeah, it's active, but it's not the same crazy liquidity profile as WETO. The whole read for me is this 18 to 19 zone. If buyers keep accepting above 18 and it can actually chew through 19 without instantly wicking back, that's still squeeze behavior. If it tags 19, stalls, and starts giving back 1850, 18, that starts looking more like thin liquidity and people chasing the top of the candle. Especially with the indexes basically asleep, SPY flat, QQQ flat, these moves are their own little universe right now. Capper back on the 1 minute, and this one's still super interesting because it's a biotech runner with real volume behind it. We've got about 39 million shares traded, up 82%, relative volume a little over 9 times normal, so this is not some dead print drifting around. But look where price is now, 7.69, so it's still fighting below that $8 reclaimed area. That's the pivot. If it reclaims 8 and holds it, not just one candle poking through, but actually holds bid above it, then momentum traders are going to respect that level. If 8 keeps rejecting, then you have to be careful, because biotech runners can go from clean breakout to full chop fest really fast. I'd rather see clean acceptance over 8 than a bunch of wick and fade candles right under it. MDXH now, pulling up the 1 minute, and I'm not going to redo the whole volume lecture here, but just understand why it's on the board. 78 cents, up almost 69%, and the prior defense area is that 75-cent zone. That's the spot where buyers basically need to keep showing up if this is going to stay constructive intraday. If it starts living under 75 instead of wicking through and reclaiming, then the character changes pretty fast. Also, penny stock biotech adjacent diagnostics name, high dilution risk on the board, so yeah, chart first, risk always in the back of your mind. AKAN next. 1 minute up here, and this is a different animal. Low float, only about 2.2 million in the float. Market cap barely over 4 million, so these candles can get silly fast in both directions. The live price is around 820, up 64%, and the read is pretty simple. Can it stabilize above the low 8s, or does it start leaking back toward that prior air pocket area underneath? I'd be watching $8 as the clean line. Above it, the tape can keep trying to base. Below it, you don't want to see slow grind selling turn into one of those low float elevator down moves.
Thanks, Markets Desk. Breaking oil headline first, because this one actually matters for the macro plumbing. ProTerminal's newsroom is tracking that India's July oil imports from Russia hit a record 50.83% share. That's 2.47 million barrels a day. What we know, Russia was just over half of India's crude import mix in July, so the energy relationship is deepening in a very real, measurable way. What we don't know yet, the exact pricing, how much was term versus spot, whether this pace carries into August, and how shipping, insurance, or policy pressure changes the math. Market read right now, oil's basically flat around 125.05, up just 2 basis points. So crude is not panicking off the headline. But this is the kind of flow story that can quietly reroute barrels before the chart bothers sending you an invitation. Next headline, soft PPI helped push the S&P 500 to a fresh all-time high at 7,826. That's the market rewarding cooler inflation pressure. Pretty simple cause and effect. Lower producer inflation can ease the pressure on margins and rates, which is why growth and tech tend to like it. But here at the macro desk, we're not throwing a parade for one data point. SPY is sitting around 777.13 today, down a tenth. QQQ down about 17 basis points, and VIX is still near 19.5. So the message is, inflation relief helped the bigger trend, but today's tape is still mixed, not euphoric. And the big AI capital headline, NVIDIA plans to raise $500 billion to fund AI build-out. Huge number, obviously. That's not a CapEx plan. That's a small country with a GPU budget. What happened? The company is signaling a massive expansion push around AI infrastructure. Why it matters? If hyperscaler demand stays strong, it reinforces the whole AI hardware and data center chain. The other side of it is capital deployment and dilution questions. When the number has 12 zeros, shareholders are going to ask how efficiently that money gets used. Coming up, the markets desk has another mover scan, and then we've got Valen candle analysis on deck.
Thanks, Macro Desk. Quick tool check here at the markets desk. This is ProTerminal, and I'm starting with the dilution center, because honestly, this is where a lot of small cap stories either pass the smell test or get real messy. Shelves, ATMs, offerings, that stuff matters when a stock is ripping on volume. Green candle is one thing. Capital structure is another. Now, flip to the movers board. This is the page we've been living on all morning. Wedo, Onfo, Capper, MDXH. The board gives you the move, the relative volume, the price, the gainer-loser split. And look, the markets desk loves momentum, but the board is not a buy button, it's a radar. It tells you where the tape is loud, then you still have to check the chart, the float, the filings, the risk. Let's use SURG as the example, because that one already hit a level we flagged earlier. Instead of just saying, hey, it's moving, you can pull the company page and actually check the filing trail. Oof, this is the part people skip. Recent filings can change the risk profile fast. Then hit insiders, same idea. You're not trying to predict every candle. You're trying to avoid flying blind when a ticker is hot and chat is screaming about it. And then, boom, 1 minute terminal chart. This is where we read the actual tape. Candles, wicks, volume bursts, failed pushes, real acceptance versus fake breakout noise. Everything you're seeing on the stream, movers, charts, dilution, filings, insider data, that's ProTerminal. It's research tooling for self-directed traders, educational stream only, no magic signals. If you want to follow along with the same screens, sign up at proterminal.io. Coming up, we're jumping right back into the movers scan.
All right, markets desk back on the movers board. Let's hit what's actually moving right now. SPY and QQQ are basically flat red. IWM's green by 0.33%. VIX under 1950. So this is not broad panic. This is small cap tape doing small cap tape things. Wedo's still sitting at the top. MDXH right behind it. Capper, Onfo, HHS. Then look at the red side too. INV down 50%. MVIS still heavy. So the question is simple. Which of these are holding structure, and which ones are just late morning exhaust candles? We're going 1-minute charts fast. Wedo first, and I'm not rereading the whole stat sheet, we already did that. Scoreboard check. That $9 warning line we flagged earlier got hit, and now this thing's back around 940. That matters. It means the flush did not completely kill it yet, but oof, this is still a 5.7 million float name, trading 41 million shares with 910 times relative volume. That's air pocket territory. On the 1 minute, I care about two things now. Can it actually accept above 950, or does it lose 9 again and turn the whole reclaim into a trap? If it's just wick above 950 with no hold, I don't love that. If it sits above 9, consolidates, and volume doesn't vanish, that's a cleaner tape read. But yeah, at 160% green, this is not something you chase just because the percent column is screaming. MDXH. Next. This is just a penny stock follow-up, not a victory lap. We're sitting around 91 cents, up huge, volume's ridiculous, over 100 million shares, roughly 580 times average. But the big thing here is the quality of the move. This one has high dilution risk, so I'm not treating every green candle like it's clean. The line is super simple, 90 cents. If buyers keep defending 90 and it keeps basing above it, okay, the bid's still alive. But if sellers stuff it back under 90, especially with volume, that's where these penny names can go from momentum to everybody trying to find the door real fast. Now, Cap R, cleaner biotech momentum than the sub-dollar stuff, but still don't fall asleep on the fade risk. Stocks around 753, up almost 79%. And the volume push is real, 41 million shares traded, about 10 times normal. What I care about on the 1 minute is that prior $7 reclaim. If 7 stays underneath it as support, the chart still has that stair-step look. If it loses 7 and starts making lower highs after that big volume burst, then you've got the classic biotech squeeze cool-off. Strong tape, yes, but after a move like this, the second push has to prove itself. ONFO next. This is the squeeze quality check right here. We already had that 350 area tagged earlier, and yeah, that got paid. Now the stock's sitting around 392, up about 70%, with 33 million shares through it. For a 5 million share float, that's real turnover, so the tape is not quiet. But the difference now is $4. If ONFO can actually accept above 4, not just poke it, not just wick it, then the squeeze still has some structure. If it stuffs at 4 and starts living back under that level, that's usually where late chasers get trapped. High dilution risk is on the board too, so I'm treating this as a tactical candle read, not some clean investment story. Now I want to compare HHS against STKH, because they're both up around 50%, but they are not the same trade at all. HHS at about 434, smaller float, roughly 3.9 million, volumes over 3 million, relative volume around 32 times. That's still thin, but it's at least a cleaner continuation profile. You want to see whether buyers keep defending the prior breakout area, and whether it can hold above VWAP instead of just doing random air pockets. Now flip that to STKH. This one's about 431, also up basically 50%, but look at the float number. Under 500,000 shares. That is ultra thin. 23 million shares traded on a float like that is wild, and relative volumes over 240 times. So yeah, it can keep snapping around, but the same thing that makes it squeeze can make it rug pull instantly. HHS feels more structured. STKH is the microwave tape. Fast, violent, and you've got to respect the spread and halt risk. Alright, red side reset real quick, because not everything on this board is a rocket. INV is the nasty one here. Around $1.77, down 50%, 10 plus million shares traded, and it's still sitting under that 180 line. So for me, that's the scoreboard. Below 180, sellers are still driving the bus. A reclaim above 180 would at least make the bounce interesting. But under it, that's still a broken tape, not a dip celebration. Now, MVIS, different animal. Bigger float, older retail favorite name, but down 46% near 203. The volume is elevated, but not insane relative volume like some of these microcap runners, so I'm treating 203 as the reclaim check. If it can't get back over that area and hold it, sellers are still in control there too. Last two score checks and then we'll move on. AKAN first. This is the low float one, roughly 2.2 million float, stock around 750 on the board, up about 50% with 15 times relative volume. The level I care about is that low 8 area. If it's stabilizing back into the 8s, okay, the squeeze still has some structure. If it keeps rejecting below 8, then it's just another low float name giving back the clean part of the move. And then MF, super quick, no need to redo the whole squeeze story from earlier. It's around 1478, up 48%, 20 times relative volume. So the question is just structure. Can it hold the mid-14s, or does it start losing those higher lows and turn into a round-trip chart? Alright, that's the small cap heat check for now. Fireworks on the board, a couple red side warnings, and we'll reset the tape and jump into the next read.
Thanks, Markets Desk. Quick Stock Whisperer check-in on the simulated paper book. The new one here is WDAY. I just opened 50 shares long at 196.51. It's trading basically flat to entry, around 196.58. So this is not some victory lap. It's a defined risk starter. The thesis is simple. There's a high-impact takeout discussion headline around Silver Lake and Workday. And for now, the stock is still holding that post-headline bid. My first warning line is 192. If that starts failing, the catalyst premium may be leaking out, and I don't want to argue with that tamed in the paper portfolio. Now the bracket is the important part. WDAY has the protective stop sitting at 188.50, and the upside bracket is 214. Again, simulated account, broadcast portfolio, not something to copy. I'm showing the process, catalyst, level, risk. The rest of the book is steady. F is still the bigger open green position. SPGI short is working with the stop at 423.90. And GS is slightly green after that earnings short, with its 1064 invalidation still sitting there. Cash is about 59.6K, so we're not maxed out, but I'm not forcing another entry ahead of the 2 p.m. Michigan sentiment data.
Thanks, Stock Whisperer. Let's snap Valen onto the 1 minute and keep this tight. Okay, thirst read. Not a clean trend. This thing opened around 708, popped early towards 719, and then, nope. Lower highs started stacking. Market's basically flat. IWM's green, so if Valen can't build real bid with small caps catching a little love, that matters. Right now it's sitting near 701, and the chart is telling us range, chop, sellers showed up once already. Oof, look at that mid-session candle. That's the one. Volume spikes over 28,000 shares, price flushes towards 691, and that's the first real information on this chart. Before that, fine, whatever. 705 to 715 chop. Little pushes, no real decision. But when volume expands and price goes down, the markets desk pays attention. That's sellers voting with size. So now, the board is simple. 690 is the floor area, not magic, just where the base is trying to form. If Valen loses 690 with fresh volume, that base can crack fast. On the other side, 710 is the first reclaim. If it can't get above 710, it's just bouncing inside the damage from that flush. Watch 710 above, watch 690 below. Now, right side of the chart, this is the base attempt. Small bodies, lighter volume, a couple mild pushes back towards $7 to 710, but no real breakout yet. So I'm not calling this momentum, I'm calling it a test. Buyers are trying to absorb after the flush. Sellers already proved they're there, and this is exactly where choppy names fake both sides. If it reclaims 710 with volume, okay, then the tone changes a little. If it slips under 690, especially with another candle like that breakdown candle, then the base failed. Quick levels, clean scoreboard. Coming up, we've got the deeper Valen pass on the rundown, so we'll see if there's a catalyst behind this tape. But chart first, this is still a range until it proves otherwise. All right, back to the movers board. Markets desk wants the names with actual volume, not noise. SPY and QQQ are basically a touch red, IWM is green, VIX is leaking a bit, so this is still a small cap tape. Wedo is back at the top, sitting right around that 950 area. MDXH still a double under $1. Capper is holding the 7 handle. Onfo is still flirting with 4. MF is green but jumpy. And look down the board, HHS, ACAN, STKH, still plenty of momentum, but this is not a clean all runners go tape. We're going chart by chart now. Okay, Wedo first. This is the scorecard name. Earlier, that sub-9 break got hit. Fair. Sellers won that round. Now it's reclaimed and it's sitting right on 950. So the whole read is acceptance versus failure. Above 950, buyers are still defending the top of the move. If it loses 9 again, oof, that's a failed reclaim look, and the chase can get ugly fast. I'm not overcomplicating this one. Market's flat. This thing is still massively green, so the level matters more than the headline. Watch 950 above, watch 9 below. MDXH next, and this is the classic under a buck double check. Up about 100%, volume is huge, 131 million shares, 700 times normal volume, so yeah, this is not a quiet move. But the question now is super simple. Is it actually holding strength under $1, or is this just the backside starting to leak? I'm watching that 90-cent area first. If buyers keep defending around there, and it keeps popping back toward 95, 96, that's still controlled. But if 90 cracks clean, then you can feel the momentum crowd start to back away. And $1 is the big psychological ceiling. No need to overcomplicate it. Under 1, sellers can lean. Back above 1 with volume, totally different tone. Now, CAPR. This one's cleaner for the biotech crowd. It's not the same tiny float chaos as some of these other runners, but it's still up 76% while SPY and QQQ are basically a hair red, so that relative strength matters. Price is hanging around $7.40, and I'm using $7 as the line in the sand on the quick read. Above 7, pullbacks are still looking constructive. Lose 7, and then the chart can go from momentum to just a normal give back really fast. Volume strong too, 42 million shares, about 10 times average. So this isn't hidden, this is a crowded biotech move now. I want to see if dips get bought, not just one candle spike and fade. ONFO now? This is the $4 test, plain and simple. Board price is sitting just under it, about $3.94, up 70%. And the important part is the volume, 35 million shares versus normal volume around 558,000. So yeah, people are here. But with a float around 5 million and high dilution risk on the profile, I don't want to treat every pop like it's clean. For me, the line is $4. If ONFO can actually accept above 4, not just wick through it for 3 candles and slam back under, then the tape changes. If it rejects 4 again, that tells you sellers are still using that round number as the exit door. STKH next, and okay, this is where you really have to slow the brain down because the percentage move looks fun, but the structure is dangerous. 44% green, 23 million shares traded, relative volume 240 times normal, but the float showing under 500,000. That is tiny float behavior. This can rip, halt, reopen messy, spread out, and then trap both sides in the same 5-minute window. So I'm not hyping this one. I'm reading it like a momentum instrument only. $4 is the obvious sanity line on the chart. Above it, buyers are still defending the move. Below 4, especially if volume dries up on the bounce attempts, that's where this starts looking more like a failed squeeze than a clean breakout. All right, one more on the green side before we flip the board red. HHS. This one's a little cleaner, honestly. Hart Hanks, customer experience, marketing services, advertising agency bucket. Not the same pure chaos tape as a sub-dollar biotech or a tiny float food name. Board has it around 435, up about 55%, 3.3 million shares traded, and that's 32 times normal volume. Float's only about 3.9 million, so yeah, it can still move fast. But the question here is pullback quality. If the 1 minute is stair-stepping, holding VWAP, and buyers keep defending higher lows, that's real demand. If it starts losing VWAP and every bounce gets sold, then it just becomes another morning runner fading back into the pack. For HHS, I'm watching the $4 area as the cleaner psychological line. Above it, bulls still have something to work with. Below it, the momentum crowd probably gets a lot less patient. Now, quick red side reset, because this matters too. Not every volume name is a squeeze. Some of them are just getting smoked. INV is the ugly one, around 177, down 50%, 11 million shares, so sellers are absolutely in control unless this thing can start reclaiming prior breakdown zones on the 1 minute. I'm not trying to overcomplicate that. When a stock is down half and every pop is getting rejected, the first job is just stop the bleeding. Then MVIS, same idea but a different personality. Bigger retail history name, LiDAR story, around 208, down about 45%, 8.4 million shares. Relative volume's only 1.5 times normal there, So it's not the same nuclear volume event as the gainers board. It's more of a heavy red tape. Failed reclaim watch. If MVIS can't get back over 210 and actually hold it, sellers still have the wheel. All right, good movers board lap. We hit the volume leaders, we hit the traps, we hit the red names. Coming up, let's switch gears and grab the next tape check.
Thanks, Markets Desk. Breaking from ProTerminal's newsroom. Tim Cook's final act is being framed as a $60 billion bet on Texas. What we know, Apple has unveiled a new manufacturing facility in Texas, and the reported size is about 10% of Apple's broader U.S. investment plan. Why it matters. This is Apple leaning harder into domestic production, supply chain resilience, and frankly, political insulation, the kind of thing investors care about when tariffs, China exposure, and AI hardware all sit in the same messy bucket. What we don't know yet, the exact timing of the build-out, margin impact, and how much of this turns into near-term capacity versus long-cycle capex. Market read is pretty contained so far. SPY around 777.3, QQQ around 731.5, both basically flat. So the tape is treating this as strategic, not shock and awe earnings math yet. Next tech headline, Microsoft walks away from China. The desk is tracking Microsoft closing at least 15 branch offices and joint ventures in China over the past 5 years, with that downsizing accelerating in 2026. Big picture, this is the macro desk's favorite kind of story, because it's not just a stock story, it's geopolitics wearing a hoodie. For Microsoft, the trade-off is pretty clean. Less exposure to the world's second largest economy, but potentially lower regulatory and political risk. Investors are going to weigh slower regional growth against a cleaner risk map, especially with the dollar ETS down about 0.37% and gold up roughly 1%. That's the market quietly saying, yep, global risk still exists. And the third one ties it together. AI killing software? One analyst says, quote, there is no software apocalypse. The point here is that Microsoft, NVIDIA, and the rest of big tech are still spending heavily on infrastructure, which argues AI may be expanding the software stack instead of just eating it. That matters because the whole AI trade lives or dies on CapEx turning into durable demand. Chips, cloud, applications, the whole buffet line. With VIX near 19.4 and lower on the session, the market isn't pricing panic today, but it is asking for proof. Coming up, we'll flip back to the movers board and see whether the single name tape agrees with the headline tape.
Thanks, Macro Desk. Let's pull VALN back up and score this biotech move. Here we go. VALN at about 7.07, up roughly 25% on the day, while SPY and QQQ are basically red by a tenth. So yeah, relative strength is real, but don't get sloppy with it. This is a small cap healthcare name. Volume is massive versus its normal tape, and the chart is not clean trend up anymore. It's range. Oof, look at that wick. Early push into 719, volume comes in, buyers try to flex, and then it just can't hold it. That's the first tell. After that, lower highs, lower lows, and the heavy volume shows up again on the flush towards 686, 687. So the market already gave us the map. 719 is the top of the range, 686 is the bottom, and everything in the middle is chop unless volume changes the tape. Right now, these latest 1-minute candles are stalling around 702 to 705, which is basically right back near the open at 704. That's not a breakout. That's hesitation after a bounce. Here at the markets desk, I'm not calling that momentum until it actually clears the failed high with volume. Above 719, different conversation. Below 686, that base is gone. Now the catalyst matters here, so let's hit the news tab. This morning's headline: Pfizer and Valneva's Lyme disease vaccine candidate marketing authorization application was validated by the European Medicines Agency. Key wording: validated, not approved. Validated means the review process is moving. And for a vaccine development name, that's enough to wake the tape up. You've also got Valneva's half-year update, from yesterday, sitting right underneath it. So the stock is reacting to a real headline stack, not just random scanner noise. But the chart still gets final vote. Almost 2.26 million shares traded, versus a normal average around 24,000. That's huge attention, and huge attention cuts both ways in biotech. Back to the chart for the live read. This one's simple now. The existing floor flag is still live. If sellers push this back through that lower range area, especially with volume, the post-headline bid starts looking tired fast. If buyers want control back, they've got to do more than bounce the midpoint. They need acceptance through 7.19, because that's where the first push failed. So VALN is not a chase read for me. It's a scorecard name. Failed high, defined low, lighter volume in the middle, and a biotech catalyst underneath it. Coming up, we'll snap back to the movers board and see what else is actually moving right now. All right, let's hit the movers board, because the indexes are basically asleep, and the small cap board is absolutely not. SPY and QQQ both down a hair, IWM green by about 0.3, VIX slipping under 20. So yeah, mixed tape, but look at these individual candles. WETO still the monster on the board, up about 156%. MDXH still under a buck, but up 80 plus. ONFO holding above 4 after that earlier push. Capper, HHS, STKH, all green, all doing actual volume. And then red side, INV down 53, MVIS down 45. So this is not a broad market story. This is single name flow, relative volume, and whether these charts are accepting higher or just trapping late chasers. First chart, WETO. And oof, this is exactly why we keep score on levels. That 950 area we flagged earlier did get tagged, but now it's back underneath it. So the question is simple. Was that acceptance, or was that just a squeeze spike? Price around 924 on the board. Relative volume almost 970 times normal. That's ridiculous. And the float is only about 5.7 million. So this thing can move fast both ways. For me, the markets desk is watching the same two zones. Reclaiming 950 with real volume would clean up the tape again. But if it loses $9, that's where the momentum can start to look tired. Not calling a trade here. This is a very fast small cap runner, but the chart has to prove it can hold the upper range. Now MDXH, totally different flavor, because this is under a buck, sitting around 85 cents, and the volume is just ridiculous. 147 million shares, almost 790 times normal volume. So yeah, the tape is paying attention. But the level map is pretty simple here. 90 cents is the first reclaim attempt, and then $1 is the real psychology line. Under $1, every pop can get really jumpy, spreads can get weird, and this one does have high dilution risk showing. So I'm not treating this like a clean large cap breakout. I'm treating it like momentum with landmines. If it keeps failing under 90, that's sellers still leaning on it. If it can reclaim 90 and actually hold it, then chat starts watching that $1 magnet. ONFO next, and this is the cleaner checkpoint from earlier. Did $4 hold after the hit? Right now it's still above it, about 413 on the board, up almost 79%, so the pullback hasn't broken the obvious line yet. But watch the quality here. If the candles are bouncing off 4 with lighter selling and then buyers step back in, that's constructive. If it keeps tapping 4, bouncing weaker each time, and volume shows up on the red candles, that's seller pressure building. 5 million-ish float, high dilution risk, 41 million shares traded. This is still a small cap momentum name, not something to marry. 4 is the line that keeps the chart alive for now. Capper now. This is the biotech momentum one, and I'm not going to rehash the whole backstory here, because the chart is the story at this point. It's up about 65%, trading basically right under $7. And the volume's the part that matters. 43 million shares versus normal volume around 4.3 million. So not the crazy 900 times thing like Wedo, but still real participation. On the 1 minute, I'm watching whether 7 turns into acceptance or just a magnet. If it keeps tapping 7 and sellers keep absorbing it, that's a very different tape than a clean push, hold, and base above it. For me, Capper is all about, does volume stay heavy after the first move, or does it turn into those lower high bounces where the bid just gets tired? HHS next. Cleaner story, customer experience name, And honestly, this is the kind of relative strength that stands out because the big tape is barely moving. SPY and QQQ are both basically down a hair. IWM's only green by a little, and HHS is still up 55% around 437. Volume's 3.4 million against roughly 100,000 average, so that's not subtle. The key here is $4. Above 4, the move still has structure. Under 4, you start asking whether that whole breakout got too stretched and now it's just air pockets. Float's under 4 million, so it can move fast both ways. Nice when it's stair-stepping. Nasty when the liquidity disappears. STKH, now, and this one is where you've got to respect the mechanics. It's around 440, up about 53%, but the float on the board is under 500,000 shares, and the volume is already over 23 million. So yeah, that explains the wicks. This is not a smooth institution-style chart. This is tiny float liquidity behavior. If it's holding above 4, fine. The tape still has a bid. But if 4 starts cracking and the candles start stacking red under it, that's where these can turn from momentum to air pocket really fast. Medium dilution risk on the board too, so I'm not treating this like a clean fundamental re-rate. This is a tape trade. Spreads matter, size matters, and the next flush can be violent. Now flipping to MF, this is a different look. Mid-teens, about $15, up 51%, a little over 2.2 million shares traded. So not Wedo-style insanity, but definitely active versus its normal volume. I'm not building the whole read around float here. The structure is the thing. 15 is the clean psychological area. If it can stay north of 15, it still looks like buyers are defending that mid-teen zone. If it loses that and can't reclaim, then the move starts looking more like a squeeze that ran out of buyers than a clean continuation. All right, quick reset on the red side, because this matters too. Not everything on the board is a chase. INV first, down 53%, sitting around $1.69, and the volume is real, over 13 million shares. This is seller control until proven otherwise. For me, the simple reclaim is $1.70. If it can't get back over that area and actually hold there, every little green candle is just a bounce inside a downtrend. And if it starts pressing fresh lows again, you know the shorts and trapped longs are still in charge. Now MVIS, bigger, more familiar name, but the tape is still ugly. Around 207, down about 45%, and relative volume is only 1.6, so it's not the same kind of small float eruption we were just watching. 210 is the tiny reclaim line I'd care about on the 1 minute. Below 2, that's the psychological level where it can get heavy again. And one more quick note on BANL before we wrap the scan. Yes, it's green almost 50%, around 1048, but volume is only about 68,000 shares with relative volume under 1. So I'm not putting it in the same bucket as WETO, MDXH, ONFO. Liquidity is the story there, and thin tape can make the percentage move look louder than the actual trading interest. All right, that's the movers lap. We've got WETO, ONFO, STKH, MF levels marked, and the red side reclaims on INV and MVIS. Let's keep those on the board and roll into the next tape check.
Thanks, Markets Desk. All right, quick news brief from the macro desk. And we're starting with Apple. Headline here, AI could push Apple into a product cycle analysts haven't fully modeled yet. What happened is pretty simple, even with mixed analyst sentiment out there, including a recent downgrade. The next 12-month window around the iPhone 18 cycle is being framed as a potential AI reset for Apple's ecosystem. Why it matters? Apple doesn't need a tiny app win. It needs AI to make the hardware upgrade cycle feel necessary again. And the market angle on Apple is bigger than just Apple. If AI actually drives replacement demand, that feeds into semis, memory, App Store activity, services attach rates, the whole supply chain dinner table. If it doesn't, then AI stays more buzzword than checkout button, and Wall Street has to keep squinting at the same iPhone unit math. With QQQ sitting around 731 and basically flat, this is one of those mega cap narratives the index can't really ignore for long. Next one, Capricor Therapeutics is facing securities class action headlines. The desk is tracking multiple law firms announcing lawsuits tied to Capr, with investor application deadlines listed for September 28, 2026. The important part for traders is not the legal marketing noise. There's always confetti when lawyers find a biotech chart. It's that litigation can add a second volatility engine on top of the normal clinical and regulatory risk. Capper was already a mover today, so this headline matters for how clean or messy that move gets. All right, quick market minute from the macro desk for everybody just jumping in. It's 11:02 Eastern, and the tape is doing that classic Friday thing where it looks calm until you actually read the menu. SPY's at 776.97, down 0.12%. QQQ's at 730.83, down 0.17%. But the Russell's green. IWM 304.70, up 0.40%. So the big cap growth trade is a little heavy. Small caps are catching a bid. And VIX is not exactly screaming. 19.48, down about 0.7%. That's a mixed market, not a broken market. The line I care about on the NASDAQ side is that 731 neighborhood on 2QQ. It's been the morning's little trapdoor. Hold it? Fine, the tape keeps chopping. Lose it with volume, and the mega cap mood gets a lot less cute. The cross-asset story is the interesting part. Bonds are not helping much. TLT's down 0.54% at 82.14. IEF's down 0.12%, so yields are leaning firmer without us needing to invent a 10-year quote. The dollar's softer. UUP down 0.34% at 28.09, and the yen ETF's up 0.32%, which matters even if you only trade US stocks, because FX is basically the smoke alarm before the fire marshal shows up. Gold's bid, GLD 401.99, up 0.76%. Oil's also bid, with USO 125.63, up 0.48%. While crypto risk is ugly, BLTO down 1.3%, Coin down 3.5%, NSTR down 5.2%. Crypto is highly volatile and less regulated, so I treat that more like a risk temperature gauge than a clean market oracle. The two stories still driving the day: AI, geopolitics around Microsoft and Apple supply chain spending, plus the market waiting on retail sales at 12:30 and Michigan sentiment at 2. Coming up after this reset, we're back to the market mover scan, then mega cap watch.
Thanks, macro desk. All right, movers board, let's go. Index tape is pretty sleepy here. SPY down a hair, QQQ a little red, IWM green, VIX lower. So when the top of this board is doing triple-digit moves, that's not market beta. That's single-name heat. On FO up 131% at 534, 51 million shares, almost 93 times normal volume. WEDO up 114%, and the relative volume there is just silly, near 990 times. MDXH still under a buck, 155 million shares traded. Then Capper, HHS right behind it. Oof, look at this board. This is small cap momentum, chat. Exciting tape, but it bites if you treat every green candle like it's clean. First chart, ONFO. This is the cleanest headline on the board just because the volume is absurd. 51.8 million shares against a float reported under 5 million. That means the float has turned over again and again. Earlier, that $4 line we had on the scoreboard got taken out. Now the game moved higher. Price is $5.34. So I'm watching $5.50 as the next acceptance spot. Not a prediction, just the level where buyers have to prove they're still in control. Under $5, this starts getting sloppy fast. And remember, ProTerminal has dilution risk marked high here, so this is not a clean mega cap grind. This is low float, high volume, high risk momentum. VWAP is the referee on the 1 minute. Hold pullbacks above it, momentum traders stay interested. Live below it, and the fade risk gets loud. WETO next, and yeah, the $9 breakdown did its job. That level got smacked, so I'm not trying to overcomplicate this one now. Price is sitting in the high 7s, still up over 100%, still doing monster volume, about 44 million shares, and that relative volume number is just ridiculous. But the chart question is super simple. Can it reclaim 8, or is 8 just the next lower high trap? If it pops into 8.00, stalls, and sellers reload right there, that's not strength. That's just a bounce into resistance. If it actually accepts above 8 and holds it for more than a quick wick, then the tape changes a little. But below 8, after losing 9, you've got to respect that the momentum has already started stepping down. MDXH. This one's a different flavor because it's under $1. So I want volume confirmation, not chat room excitement. It's around 81 cents, up 76%, and the volume is real, 155 million shares, versus basically nothing on the average day. But the level is still the same. 80 cents needs to keep acting like support. If 80 starts getting chewed through on heavy volume, that gets sloppy fast. The open upside callout is still 90. That's the reclaim line, not a price target, just the level where you'd say, okay, buyers actually took back the prior pressure zone. Between 80 and 90, it's chop with a lot of volume. Above 90, different conversation. Below 80, momentum starts looking tired.
Thanks, Markets Desk. Breaking here from the macro desk. Rising U.S. Treasury yields are leaning on stocks right now. What we know? The 10-year yield has jumped near 4.2%, and that's enough to put pressure on equity multiples, especially anything long duration, growth, tech, the stuff that needs cheap money like a plant needs water. What we don't know yet is whether this is a one-hour bond tantrum or the start of a broader repricing. The market read is pretty clean, though. SPY sitting around 776.9, QQQ around 730.6, both a little red, while TLT is down at 82.14. Bonds are doing the talking. Stocks are just pretending they had other plans. Next headline, Fed officials are signaling patience on rate cuts. The desk is seeing the same message we've heard all morning. Data dependent, no rush, and the market maybe doesn't get relief as quickly as it wants. Why it matters? If the Fed is patient while yields are pushing near that 4.2% zone, traders have to recalibrate the easy money assumption. That doesn't mean stocks have to fall apart, but it does mean valuation-heavy names don't get the same free pass. And with VIX still under 20 at 19.48, volatility isn't screaming yet. It's more like quietly clearing its throat in the back of the room. Third story. Major tech earnings disappointment is back on the tape. A leading tech company posted weaker than expected revenue and lowered guidance tied to softer AI-related demand. And that's the phrase that matters, softer AI demand. We're not going to turn one print into a whole cycle call. That's how macro desks get banned from family dinners. But the read-through hits the mega-cap complex, with AAPL and MSFT tied to the story on the board. QQQ around 730.6 tells you the market is not treating this like a disaster, but it is enough to keep the Nasdaq under pressure while yields are up. Coming up, we'll kick it back toward the movers board and see who's ignoring the macro gravity today.
Thanks, Macro Desk. Let's pull up AMZN and hit the bigger chart first. Daily view. AMZN's around 264, down about 0.3. So yeah, basically moving with a soft QQQ tape, not exactly leading here. Bigger picture though, this is still above the key moving averages, 20, 50, 200 day, so the longer trend hasn't fallen apart. But look at the candles. Big run from the 220s into the high 270s, then stall. Oof, look at that compression. This is a base now, not a clean breakout. I'm watching 278 above as the daily lid, and 256.60 underneath as that first 20-day support zone. Alright, let's drop down to the 1 minute. This is the tactical part. AMZN opened around 265.20, couldn't really hold above it, flushed to 263.48, and that dip near 264.46 came with the heavy volume. Sellers were real there. Then buyers answered with a bounce toward 265.58, also on volume, but now, chop. It's sitting around 263.75 to 264, kinda heavy. No clean bid yet. So the map is simple. 265.20 is the reclaim line. Above that, it stops looking weak intraday. Below 263.48, the base cracks, and that QQQ 731 trapdoor the macro desk flagged starts to matter more. Coming up, we're right back to the movers board. All right, let's hit the movers board. Straight to the tape. No victory lap. Markets desk has SPY and QQQ a little red, IWM green, VIX still under 20, so small cap momentum is still where the action is. Top of the board is still wild. ONFO, WEDO, MDXH, then KIPR, and HHS right behind it. But we're not just reading percentages here. We're charting what's still paying traders and what's already getting heavy. WEDO is the one I want first. Huge move, huge relative volume, but it's under that existing 8 reclaim line. So now the question is simple. Real second leg or lower high trap? Pulling the 1 minute up. WEDO 1 minute on screen. Oof, look at that wick. This is why the markets desk slows down on runners after the first big snap. Price is around 7.69, still up roughly 113%, and relative volume is absurd, about 1,000 times normal. So participation is not the issue. Structure is the issue. The clean line is still that 8 reclaim from earlier. If it can't live above 8, this bounce is just working inside damage. Underneath, I'm watching 7.50 as the shelf. Lose that, and you can start to see trapped chase from the last push. Float's only about 5.7 million, so these candles can move fast both ways. I want to see green candles expand on volume, not just skinny upticks. Next pass, we'll go right to ONFO and see if 5.50 is actual acceptance or just another low float fakeout. On FO now, and yeah, this is the cleaner one to frame by levels. It's up about 147%, 58 million shares traded, relative volume over 100 times normal, so the crowd is definitely here. The line I care about is 5.50. If this thing keeps accepting above 5.50, that tells you buyers are still willing to pay up after the first big move. But if it loses 5.50 and then can't defend 500, that's where the whole breakout starts looking a lot more fragile. So I'm not chasing the green candle here. I'm watching whether dips get bought above 5.50 or whether every bounce starts getting stuffed back under that area. MDXH next, totally different personality, because this is still an under $1 name, trading around 82 cents, and it's doing monster volume, about 159 million shares, 800 plus times relative volume. The support shelf here is 80 cents. That's the spot. If 80 keeps holding and the candles keep building above it, fine, momentum is still alive. But if it starts living below 80, especially with heavy red volume, that's seller control coming back fast. Also, don't ignore the structure here. High dilution risk flag, healthcare microcap style move, sub-dollar tape. These can rip, but they can also unwind violently. So for me, it's 80 cents first. Then whether buyers can actually reclaim and hold higher instead of just producing one quick pop. Capper now. And this one's way less chaotic than the first couple. It's still a big mover. Up about 55%, trading right around 650, 46 million shares. But the question is simple. Is this a healthy pullback? Or are sellers just building lower highs under 7? For me, 7 is the obvious lid on this chart. Everybody can see it. If it starts reclaiming and holding above 7, then the pressure flips a little bit. But if it keeps stalling below that, and the mid-6s start leaking, especially around 650, then yeah, that's not controlled anymore. That's supply taking over. Biotech name, big volume, so the candle behavior matters more than the headline vibe here. HHS next. This is the smaller float one in the group, only about 3.9 million float, so respect to speed on both sides. It's up 54%, sitting basically at 434, and the level we cared about was that 435 momentum shelf. This is the kind of chart where, if $4 is still holding cleanly underneath, it's not dead, it's just digesting. But if 435 keeps rejecting, and it starts slipping back toward 4, you don't want to pretend that's strength. That's the whole read. Above 435, momentum can stay alive. Below 4, the breakout starts looking a lot more tired. Loser, check now. BZAI first. This is the other side of the board, right? Not the squeeze chart, not the happy momentum chart. Down about 44%, trading around 65 cents. 19 million shares, about 8 times normal volume. So there's real activity here, but sellers are still the main character until this thing can reclaim that 70-cent area and actually hold it for more than one little green candle. And because the board's showing high dilution risk here, plus it's sub-dollar, I'm not treating the first bounce like a clean reversal. Watch 65 cents underneath. If that keeps slipping, it's still seller control. All right, flipping to INV. Same idea, different structure. Down 53% around a buck 68, 16 million shares, relative volume just over 8. Bigger float than the tiny runners, so it doesn't have that same snapback feel. First reclaim attempt is 170. If it keeps rejecting there, bears still have the wheel. If it bases above it, then okay. Now we can talk about a real stabilization attempt.
Thanks. Markets Desk, quick paper book reset from the Stock Whisperer. We just closed the NFLX line, 100 shares, and the reason's pretty simple. It was only marginally green, it was not the active catalyst on the tape, and the cleaner setup right now is MSFT off that earnings and AI monetization headline. This is the show's simulated paper portfolio, not a copy signal, but that's the discipline. Thesis first, slot management second. Current book is back to 5 open lines. F long 600 from 1385, now 14.165, up about 189 bucks. GS short 10 from 1038.24, now 1035.19, up 30 and change. PYPL long 150 from 59.62, basically 60 bucks now, up 57. SPGI short 20 from 424.16, now 415.88. That's the best open winner at about 165 bucks. And WDY long 50 from 196.51, now 196.84, barely green. So yeah, small green book, controlled, nothing heroic. Now, the risk stack. F, GS, and WDAY still have bracket logic working. SPGI has stop protection, and PYPL is the one that only has the upside target sitting there. So that's the position I'm watching most carefully if it starts to lose the tape. The MSFT idea is not open yet in this paper book. The first attempt got blocked by the 6 position cap. NFLX is now cleared, and I'm watching 2 clean levels. 496 below is the failed reaction line where the setup gets reassessed, and 505 above is the earnings momentum confirmation area. AAPL is still on the side screen too. 308.50 is the reclaim level from earlier. If the trigger isn't clean, no trade. Simple as that. Coming up, we'll hand it back toward the mover's scan. Thanks. Stock Whisperer, quick tool check for everybody asking what the Markets Desk is using on screen. This is Pro Terminal. First stop, Dilution Center. This is where I want the shelf stuff, ATM risk, offering risk, all the boring but deadly background, before I get too cute with any low-priced runner. It's not a magic button, it's research context. But yeah, this is the page that keeps you from only staring at the green candle and missing the landmine underneath. Now flip right back to the board. This is the Market Movers page. Top gainers, losers, relative volume, price, market cap, the whole first pass scan. Look at WTO still sitting up over 100% with wild relative volume. Onfo right there too. And the broader tape is mixed. SPY and QQQ a little red, IWM green. So this board is how we find where the action is actually separating from the market. Not a buy list, not a chase list. It's the starting gun for research. Then, when a name catches fire, I'm not staying on the leaderboard like a tourist. I'm drilling into the profile. Pull up Wedo, hit filings. That's where recent registrations, offering language, company updates, whatever is posted, can change the whole risk picture. Then I want the Insider tab too. If there's nothing useful there, fine, move on. If there is, I want to know before the next candle rips or stuffs. And just real talk, data can be delayed, incomplete, or not posted yet. So you use this as evidence, not gospel. And then, boom, back to the 1-minute terminal chart. This is where the Markets Desk lives. Candles, volume bars, VWAP behavior, wicks, failed pops, real momentum versus nonsense. Oof, look at how fast these small cap tapes can move. That's exactly why the workflow matters. Movers first, dilution check, filings and insider context, then the chart. Everything you've been seeing on the stream. The movers, the 1-minute charts, dilution data, filings, insider checks, that's Pro Terminal. If you want to run the same process yourself, go to proterminal.io. Coming up, we're right back into the Market Movers scan.
All right, Market's desk is going to park it there. Mixed tape, QQQ still a little heavy, small caps holding green, and yeah, those MVIS, WITO, ONFO, Capper,